Hello everyone, welcome to How to Read Charts Like a Pro, Level 1. I'm Dr. Tom Carr, aka Dr. Stocks. I'm the founder and CEO of Befriend the Trend Trading, which is the parent company of the Dr. Stocks brand. We have 3 websites, drstocks.com, drstockstrading.com, and ichthusletter.com, and we offer stock pick letters, trading resources, and a private coaching service. But enough about me. Let's get on to what you're going to be learning in today's webinar. This is, by the way, a standalone webinar. It is part 1 of a 2-part series, but you will learn everything you need to know in this webinar alone to be able to read price charts up to an intermediate level. And you're also going to learn 2 trading systems based on what you have learned, the skills that I'm going to be teaching you here today. Here's what we're going to cover in today's webinar. We're going to first look at the best charting packages to use. You will need to subscribe either on the free version or a paid version to 1 or more charting packages. And we'll talk about that in just a minute. The second thing we'll talk about today are the 4 types of price charts, 4 primary types of price charts. We'll look at the 4 primary chart time frames. Then we'll look at a series of technical indicators. We'll start with moving averages, trend lines, support and resistance lines, the MACD indicator, and finally the stochastics indicator. And then in the final part of our webinar today, we're going to pull all of that together into 2 completely revealed trading systems based on the skills that you will now have. And you can go ahead and use these trading systems in tomorrow's market right away. There's nothing more you need to learn. And once you have a charting package on board, and we'll talk a little bit about that here in just a moment, you will have everything you need to go ahead and start trading the market, assuming you have a brokerage account of some kind and you have some capital in that account. Okay, so let's go ahead and start by looking first at our disclaimer. I forgot this was coming up. Let's get this out of the way. Everything taught in the How to Read Charts Like a Pro Level 1 webinar, including all strategies, systems, methods, and techniques, is for educational purposes only. No promise or guarantee of any kind is being made. Those watching this webinar assume all risks associated with any activities related to the educational material herein. They understand that active trading can result in the loss of trading capital, and isn't that the truth? That only risk capital should be used for active trading. That is especially true. And that active trading may not be suitable for everyone, and it certainly is not suitable for those with a gambling addiction, for those with very sensitive, nervous dispositions, those who, for whatever reason, get very, very anxious about losing money. It's not something you want to get involved in. It really helps a great deal if you can simply use a bit of extra money that if you were to lose it all, it would not affect your lifestyle in any way. It would not affect your ability to pay bills, provide for your families, and so on. If you can do that, if you can just set aside a little bit of trading money and extra money that you can afford to lose, then you'll be able to sleep well at night. You'll gain a great education. And then as you get some experience and begin to become consistently profitable, you can always add money to that trading account. All material is copyright, may not be copied, redistributed, or resold without permission. All right, let's get into the webinar itself. We're first going to look at the best charting packages, and let me first preface this by saying if you have an online brokerage, hopefully it's a deep discount online brokerage. I use Interactive Brokers myself, but I've used a number of other services over the years: Scottrade, SureTrade, E-Trade, Fidelity, and so on. I've used a number of them over the years. I prefer Interactive Brokers because it facilitates our managed account service the best, and it is extremely deeply discounted. Not only the commission rate, I pay less than half a cent per share, but also the margin rates are the best in the business. They also have a huge shorting inventory of stock, and if they don't have the shares to short, they will go into the market and get them for you. We're not going to be shorting in this webinar, only longs here, so we're not going to worry about that. But anyway, let's get on. Let me preface this by saying that if you have a deep discount online broker, you very likely have already access to a pretty decent charting package. And by charting package, I mean you have access to either downloadable software or a web browser-based system that enables you to look at price charts in both daily and intraday timeframes, and has a whole set of technical indicators that you can add onto the charts, and has real-time data. Now, your discount broker probably has all of that for you. I know Interactive Brokers does. The problem I have with their charts is that they're a little bit buggy as far as I'm concerned. They're a little bit hard to read as far as I'm concerned. They certainly have all the technical indicators that I need, but I do find that they're just a little bit hard to work with. It's not one of their better features. So I prefer to use a charting package. And I'll show you the 4 that I'm most familiar with and I can certainly recommend because I use them all. The first is finviz.com, which is a web-based charting service. Stockcharts.com, also web-based. TradingView.com, web-based. And then the last one, Metastock, is a downloaded software that you'll need to buy and download and then configure to your liking. The first 3 are all web-based, and they all have free versions of their service. So you can, after you create an account, a free account with each of these services, you will have access to their charting package. Now, some of the features may not be available to you. In one case, at least, you won't have access to real-time data. But for the most part, in fact, for what we're doing here with the 2 trading systems you're going to learn, you don't need to subscribe. You can do that for free, which is very good news if you're on a limited budget and trying to reduce your overhead costs, which we all should be doing in any case. Now, Metastock is a different animal altogether. We'll talk about that in just a minute. Let's look at these one by one. FinViz, free-based service. You will not have real-time data if you do not subscribe to their elite version, which runs, I think, about $35 a month. It may be less if you subscribe annually. I've been a subscriber off and on. I no longer have need of their real-time data because I'm using another service, but I do like it a lot. I use it a lot for screening for stocks, and we'll show you how that is done in a little bit. It is limited in the sense that it does not have any kind of backtesting feature. The screening service that they have is very limited on the technical analysis side, but it is very good for fundamental analysis, which we're not going to be doing here. And it's very good for building watch lists of stocks. I also think their charts are very readable, but they're not configurable. So if you're on the free service, this is all you're going to get. You're not going to get any technical indicators, which is what we'll need to run our 2 trading systems that you'll learn in this webinar. Once you subscribe, then you'll be able to click on this interactive tab right here, and then you can create charts with all the technical indicators that you want. You'll also have access to intraday charts with real-time data as an elite subscriber. But without that, you won't have intraday, you won't have charts that you can create. You will have access to both candlestick charts and line charts, more about those 2 in a minute. And you have access to daily, weekly, and monthly charts, plus the great screening tool, which we will be using in our trading systems, and more on that later. I do think, too, the charts are very nicely laid out. They're easy to read, and they do these. This is the only service that does this. It uses computer-generated trend lines, channel lines, even it'll identify certain trading patterns for you. And I've only seen that in FinViz, so that's unique to it. And sometimes I'll argue a bit with a computer as to where they put the lines. I would put them a little bit differently, or I would add an extra line or two, but nevertheless, it's pretty good. It's a good starting place. You can see that here we have a line over the tops of the trading pivot highs, and we have a line under these two major pivot lows, and that gives us a nice looking trend channel. So just looking at the chart very quickly, we can see that SPDR right here, the S&P 500 ETF, is in an uptrend. And you're going to learn all about trend lines in just a little bit. So that's FinViz. I like it, but it has limits, especially if you're not on the elite service. StockCharts.com is one that I've used for years and years and years. I mean, I've been a long-time subscriber to their service, but they do have a free service, and if you're using the free service, this is pretty much the kind of chart you'll be looking at. You can add one more technical indicator. There are only two here added, the RSI indicator here at the top and the MACD indicator down here at the bottom. But you can input a third indicator, and you can overlay. These are moving averages here, this blue line and the red line. These are two moving averages. You can put in several other moving averages if you need to. You can put in things like Bollinger Bands, Keltner channels, Donchian channels overlaid on the price chart. We won't be looking at any of that stuff, but just so that you know that those features are available. All of that for free. And the good news is that StockCharts.com gives you free real-time data. It's coming through the BATS system, which is a little bit buggy, a little bit sluggish, but it's still a lot better than 20 minutes delayed data, which is what you're getting on FinViz. So I really recommend StockCharts.com. If you subscribe, and I believe you can get access to most of their features for about $15 a month. I may be wrong about that. It might have it's been so long since I've actually had to pay for StockCharts.com because I recommend it to so many people, and they have told StockCharts, you know, I heard about your service through Dr. Stocks, Dr. Carr, and then they tag on a free month. I have so many free months now that I don't have to pay. I haven't had to pay for a while. But I think for as little as $15 a month, and maybe for like $25, $30 a month at the most, you'll get the full package. Now, what's included in the full package is their screening tool, which is, in my opinion, really worth subscribing for, because it is really the easiest and most robust technical screening tool that I have found. It's got all the indicators on there. You can configure things the way you like them. And if you're not able to do what you want to do in their screening tool, you shoot them an email, and they usually have a workaround that helps, and they'll get back to you with that. They will help you construct your screens, in other words. And if you've never done any stock screening before, you'll not know that when you start working with trading systems, as you'll be doing as a result of this webinar, you'll save a ton of time if you can simply configure the trading system into a stock screen, because then only a click of the mouse will give you the exact stocks that pass through the various filters of the trading system. In the absence of that ability, what you have to do is set up a whole long list of charts that you'll have to look at each day to determine whether they satisfy the various requirements of the system. You can let the screening tool do it for you, or you can do it yourself. If you let the screening tool do it for you, you have to pay. There's always a cost, right, in life. But if you do it yourself, you certainly can do it. It's just that you'll need more time, that's all. So that's StockCharts.com. The third tool is relatively new to me, although it's been around for at least a couple of years now, I guess. It's called TradingView.com. TradingView.com is the one I recommend in terms of their charts themselves, because I find them to be the most readable and the most user-friendly. All the technical indicators that you could ever want are available to you, both the indicators that you see at the bottom of the chart. This is the MACD indicator down here, and the overlays that you can put on the chart. This is your moving average right here, and the volume bars down here with a moving average of volume. So all of those things are available to you. And I do find that the charts themselves are very readable. They're clear. It's very easy to scroll in and out, to zoom in, to zoom out. You can, with just a sweep of your mouse, you can go back in time to look at how the chart reacted in previous months, weeks, years, and so on. And you can't do that with stock charts. It's very clunky in that regard. So TradingView is very user-friendly and really a great tool for us as far as trading technical systems go. Now, TradingView does not have a screening tool, so you may need to use TradingView in conjunction with StockCharts.com unless you want to spend a lot of time yourself eyeballing the charts. And it does not have any kind of a backtesting tool, which StockCharts.com does not either. And FinViz claims that it has a backtesting tool, but it's really not. It's just you have access to some historical research regarding technical analysis and fundamental analysis, but it's really nothing that you can't Google and find yourself online. So FinViz does not have a backtesting tool. The only one with a backtesting tool is Metastock. And that's not to say it's the only one available online with a backtesting tool, but it's the only one of our 4 recommended charting packages that has the backtesting tool. So Metastock has it all. It has real-time data. It has user-friendly charts that you can swipe and go back in time on. You can overlay all the indicators you want. You can put in all the technical indicators you want. It has an excellent, extremely robust, very sophisticated screening tool with a ton of pre-configured screens. I mean, you're going to have access to at least over 100 pre-configured screens that you can use as a base to build on. And it has a backtesting tool. And the backtesting tool is super, super easy, super user-friendly. You simply put in your trading screen, click the mouse a couple of times, wait a few minutes, and it will give you exactly how that system worked on the particular stock or set of stocks that you're interested in trading. So it's got everything. And this is a bit of a self-serving plug, but it also gives you access to my trend trading toolkit, which is an add-on. You'll have to pay a one-time fee to add it into your software, but once you do that, you'll have access to my most profitable published trading systems. Metastock approached me a few years ago about putting the systems that I outline in my 3 trading books into their software, and so we worked together on building those out. And so now with simply a click of the mouse, you can scan for the stocks that I'm looking at whenever I put my trading newsletters together. So a big advantage on your end. You'll have to pay about $300 to add that on, and if you mention my name, Dr. Tom Carr, that you heard about it on a webinar with Dr. Tom Carr or Dr. Stocks, that they'll knock $50 off that initial fee. I do get a bit of a commission when you do that, so just letting you know, I'm greasing my own spoon here, I guess. I don't know what the right metaphor is, but anyway, just to let you know that I will get a little bit of that money coming in, but frankly, I'm not making a whole lot from it, so it doesn't really matter to me that much. And I know that it's expensive because you're going to have to pay at least $100 a month for the data to feed the beast, and that puts it out of the price range of most people. I mean, I started trading back in 1996 with $2,000 in my trading account, and there was no way I was going to take 5% of that every month and spend that on real-time charting package. So don't you do that either. If you can't afford it, just let it go. You're going to be able to do everything you need to do with the 3 tools we've already mentioned, and they are very reasonably priced, and you can do it for free as well if you want to spend a little more time. All right, the 4 types of price chart are as follows. There are line charts, bar charts, point and figure charts, and candlestick charts. The bar charts are configured on 4 points of data: the open, high, low, and close. Line charts are configured on just 1 point of data, the close. Candlesticks charts are also based on open, high, low, and close, and pointed figure charts are a whole different animal altogether. Let's look at these one by one. So here we are at TradingView. I have loaded the chart with the S&P 500 ETF, SPY, or the spiders, and I've taken all indicators off the chart. Let me just explain a few features here you have in TradingView. You have your drawing tools on the left side column here, which you will use to draw in trend lines, support and resistance lines. There are a number of other tools here which we won't get into. There's a Fibonacci tool, there's Gann ratio, and so on. Pitchforks, and then you have a scribbling tool if you want to draw pictures on there. But none of those we need to worry about. I've also hidden our 3 moving averages. We'll talk about those later. You can see down at the bottom of the chart, we have your timeline. With just a simple click of the mouse, we can go down to we're at a 1-day chart. We can go to a 5-day chart. We can go to, which is the weekly chart, of course. We can go to a 1-minute chart. We can go to a 6-month chart, etc. But we're going to stay with, I'm not even sure what that is. Maybe that's a 1-minute chart. Anyway, here we are at the daily chart. The D down here in blue signals the distribution of a dividend, and don't need to worry about that. Then over here you have your watch list, and I can put in, I have a number of different I have an IPO watch list, and so you'll have all your charts here, and with just a simple click on the ticker symbol, the chart is populated with that stock. So you can scroll through your charts quite easily this way just by clicking one by one by one. Okay. So let's get back to SPY. We'll have to type that back in. Now we're at a candlestick chart here, which is your default chart that always comes up. Let's go to a line chart. And the line chart, as I said, is configured on a single point of data, the closing price of the day. The advantage of the line chart is that it eliminates a great deal of the intraday noise, gives you a very clean, clear picture of a stock, whether it's trending up, trending down, going sideways. And if you know a little bit about price chart patterns, which we don't get into in level 1, we do talk about those in level 2. There are really only a handful, maybe 4 or 5 price chart patterns that are worth paying attention to, and the rest are just not really worth it, not reliable enough, not robust enough as a prognosticator. But with a line chart, you can see those patterns much more cleanly because you're eliminating a lot of that intraday noise, the highs and the lows of each trading day. If we scroll back a little bit, take these lines off the chart, you can see that we've been in a very strong uptrend, and with this line chart, the pivot lows are very clearly seen. And we can put in our trend lines like this. We'll learn a little bit more about these in a bit, but always want to make sure your trend lines are parallel to each other. And that's where price is engaged right now, and we assume that it will just continue in that channel going forward until this lower line is broken. So line chart has the advantage of eliminating intraday noise, gives you a clean picture of trending action, as well as choppy sideways action like this kind of stuff right in here. Right? If you look at a chart like this, that's a trendless chart. It's just sideways back and forth. And I'm pretty sure that this is the summer, that's the summer of 2015. So the 2015 was not a very good year for the market. It was down slightly. It mostly just went sideways pretty much the better part of the whole year. And then we had a couple of big swings toward the end of the year. 2014 was a better year, another trending year. But again, you can see these pivot lows are very clear. the lines of the high very clear, and that is the advantage of the line chart. The bar chart is a slightly different animal. We're looking in the bar chart at 4 points of data for each bar. Let's scroll in a little bit and look at that. We can see that these are colored green and red. A bar is red whenever the close is lower than the open, and a bar is green whenever the open is whenever the close is above the open. And a bar chart contains all 4 pieces of data: open, high, low, and close. The open is always going to be the little left knob. You can see right there the little knob on the left. That's the opening price. That's where it opened at the day of trading, 9:30 a.m. Eastern Standard Time. And then you have this long stick. In this case, it's a green stick. And the lower edge, the lowest edge of that stick is the low of the day. And the highest edge of that stick is the high of the day. And then the little knob on the right is your closing price. Open, high, low, close. Because the close is above the open, this is a green bar, and the bar next to it has the close lower than the open, so it's a red bar. Even though it went very high and took out all of this high back here, it went way up, but it traded all the way down here sometime during the middle of the day, and it closed here. And the close is always your most important price point. So a line chart only gives you this. The line chart only gives you this little knob on the right. None of the rest of this is included in that information, and that's what makes it so nice and clean. It doesn't give you a very nuanced view of the market, but it gives you a nice clean view of the overall movement of the price over time. So a bar chart has the advantage of giving us those intraday moves, and if you're really getting sophisticated in your chart reading, that information is helpful to you. For example, it's helpful to me to know that at some point during the middle of the trading day here, traders and investors and hedge funds and mutual funds, they were bullish enough on the S&P 500 to knock it all the way up here to almost 237 and 50 cents, 237.50, which is a high that it hadn't seen since way back here. This is a good 2 weeks of data right here, over 2 weeks of trading. So that tells me that even though it got knocked down at the close, there is a lot of bullish strength in this market. And so when it dips down here to some of these lows and begins to rise back up again, I would like to be a buyer, because that bullish power that we saw just a couple of weeks back is likely to manifest itself again, and it sure did, with a big gap up, and then it just has consolidated in that gap area ever since. So that intraday data can be helpful. And then the same is true here. For example, here's a bar that opened way down low. It closed the previous day at 233.92, and it opened the next day at 231.88. That's over $1 gap down on the S&P 500. That's significant for the S&P. That's like about a 40 basis point move to the downside. What I like about this on the bullish side of things, however, is that that was near the low of the day, and then investors came in, stepped up to the plate, bought the low, bought the dip, and pushed it all the way back up again. When I see that sort of intraday action, I know that it's bullish, that there's no way investors are going to let price get much further than this down here. And so I'm likely to buy it the next day. And of course, that turned out to be a nice move, upward and then up again and then up again. And then, you had a few days later, you could have sold out at near 237.50. And if you were a patient holder, you could be up here around 239. 239.50, which is where it is today, 238.94. So anyway, this intraday action is helpful, but some people get a little bit, overwhelmed by it. So we're not going to worry too much about it for now. You're going to see in our two trading systems that the color of the bar is really what we're concerned about, not so much the intraday action. If you're a day trader, the intraday action is all important. But if you're not a day trader, and you won't be as a result of this webinar, then the closing price of the day is really all you need to know, and the color of the stick. So the color of the bar is really key for us, and just a little bit more about that. I'm bullish when I see a lot of green bars, and I'm bearish, or at least I want to be bearish when I see a lot of red bars. So if we scroll in, we'd have to say that this period of the market right here is a bullish period, right? Predominantly what we see are green bars. We see very few red bars. Now, a red bar, by the way, it doesn't necessarily mean that the price closed lower than the previous day. It simply means that the close of that day, of the day of the bar, is lower than the open. I mean, here's a case where the stock actually gained a little bit. It closed at 236.51, and the previous day's close was 236.28. So it gained 20 cents or so, but it is a red bar because that close is lower than the open. When I see a lot of that, close is always the most important price point of the day. So the open is where you have a lot of retail traders coming on. You have a lot of market maker action that's not necessarily indicative of the trend of the stock or the ETF or the index. The close is where the professional traders really mark their spot. So to have a close lower than the open is bearish. To have a close above the open is bullish, even if the stock or ETF lost money on that day. Still bullish because of that open above the close above the open. So a lot of green bars. I want to be bullish. When I see a mix of green and red, something very Christmassy, then I am neutral on the market. I'm not sure where it's going. It looks like a confusing market, something I would pass on and look for something better. Here's a good bullish period. See a lot of the predominance of the green bars versus red. There's a very bearish period, right? In fact, look, this whole time frame right in there is bearish, 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 right? Lots of red stuff going on. So you want to not buy that market. You might sell it short, but you don't want to buy that market. Still more bearish action here than green action. That's fairly mixed, maybe a little more green than red, and so on. So that's another way you can use the bar chart to determine overall health of the near-term time frame. This is interesting right here because this is, we had this big bullish thrust up, right? Big bullish thrust up, went way high on a couple of gaps. But in this consolidation period right here, we're not getting much strength. We're seeing some selling, some distribution as people are taking profits off the table, which is usually what happens when there's a fear of the market going down. Doesn't mean it will. Markets, change their minds on a daily basis. You have to be aware of that. But it does seem like right now is not a good time to be buying the S&P 500. Okay, so that's the bar chart. Let's look at point and figure chart, which is a whole different animal altogether. Very interesting. You won't be using the point and figure chart at all for anything that you're doing here, but it's never a bad idea. It's always a good idea to check the point and figure chart on a daily or even weekly basis of the stocks that you're interested in, of the indexes that you're interested in, to determine the overall trend. And the point and figure chart helps us determine the overall trend of the market based on price alone. Let me just give you a few pointers on how the point and figure chart is configured, because it's very different from what we've seen so far. The point and figure chart only is interested in one price point. That's the closing price of the day. And you can configure the point and figure chart to be interested in other things, like the high of the day, the low of the day, the opening price. But by default, it's interested only in the closing price of the day. And you can see that it's constructed of two types of marks on the chart. There are green X's and there are red circles. Green X's are bullish, red circles are bearish. They are constructed in columns which continue to go up higher and higher as long as the underlying stock or index continues to go higher. Once they make a significant drop to the downside after a column of X's, it shifts over to a column of red circles. And those red circles will continue to get longer and longer going down as long as the stock or index continues to drop. Once it pushes back to the upside again, it shifts from red circles to green X's. Green X's to red circles to green X's to red circles. So you get a shift back and forth between bulls and bears, bears and bulls, based on the closing price of the stock. As long as it's going up, we get green X's. Once it starts pulling back, we get red circles. Now, it's not just an arbitrary going up or pulling back. There is a mechanical number that is inputted into the point and figure chart to determine whether you were going to add another X or shift over to a column of red circles, and vice versa from red circles to green X's. In general, I think the default movement for the S&P 500 for the SPDR is that each one of these green X's represents $1 of price movement. So whenever the SPY closes up $1 and we're in a column of green X's, we're going to add another X. Then once it pulls back, so you can see the numbers right here. 1 stands for the price movement for each new X or circle. And then the 3 stands for how many of those price movement numbers you need to reverse from X's to circles, circles back to X's. You need $3 of movement to change from X's to circles. So if we get all the way up here and then over the next week, or probably over the next 3 or 4 weeks, the S&P 500 pulls back $3, say from this is right now 209, it pulls back to 206, it closes at 206 or below, then we're going to shift over to red circles. You're always going to have at least 3 red circles or 3 green X's in your column because that's the standard configuration. It has to be 3 points to get over into the new column. So a $3 rally means we shifted from red circles to green X's, and we always start with 3 green X's. And if you get a $4 rally, then you get another X. But what happened here was instead of getting another $1 rally, we got a $3 pullback. Okay, so that's how it's configured. What do we do with this in terms of reading our chart? Well, the first thing you want to do, just like with the green bars and red bars, you want to see what is predominating. Are we seeing more green X's? Are we seeing more red circles? Clearly, since this is about August of last year, August of 2016, we're seeing a dominance of green columns of green X's. Long columns of green X's, short columns of red circles. Long columns of green X's, short columns of red circles. Long columns of green X's, short columns of red circles. So I know that in terms of the intermediate trend since August or so, we are going up. We are going higher. And trends tend to continue until something significant happens, and then they'll pull back, and they might even reverse, and the trend is no longer in evidence. But as long as there is a trend, we will assume that the movement going forward will continue in the direction of the trend. That's rule number 1 with technical analysis. Befriend the trend. The trend is your friend until it ends. So I would write that on your screen, on your bulletin board, whatever, and keep that by your side, because that's a good mantra to learn. The trend is your friend until it ends. So that's one thing I want to do. I want to see what is the near-term trend looking like. Here it's bullish. And the other thing that I'm interested in is what's going on right now. Right now we're in a column of X's. So right now we're in a bullish posture for the market. I'm going to expect that the next mark on the point and figure chart will be another X. Now we can see that it's already been up there. We already had that high printed in the previous column of X's, so that's sort of a marker for us to aim at. Once we get there, once we add another X, which is going to be a print of, I guess, 239 on the S&P, on the spider, then we will match the previous high, which could be problematic if it's, you know, a double top, or if we can't get past that. But if we get past it, then we have a breakout situation, and it's just all kinds of good things happen on a breakout situation. You can see here's a previous high, we got a breakout. This is the new previous high, breakout. The new previous high, breakout. So that's the kind of thing you're looking for with a point and figure chart. What's going on in the most immediate time frame, and what's going on right now. Okay? Let's go back a little bit. Now here's, you know, not a good period, right? Look at all those red circles relative to X's. This is a confusing time period. You have pretty much equal, maybe a little more green X's than reds, but pretty healthy balance between bulls and bears. But this time period right here is clearly all about the bears. All about the bears. So when you see a big long column like this, and you get a column of X's, which is what's called a relief rally, the next time you get some red circles, you want to short that. It's going to continue to move down in the direction of the dominant trend. Short this, boom. Then we get the breakout up here, and now we're back into a bullish situation. Now we're in a bearish situation. Now we're back in a bullish situation. You see how it just goes back and forth. So that's a point and figure chart. Know what's going on right now. Know what's going on in the immediate past. And those two things will help you have a general understanding of what's going on in the market. Okay, one last chart we'll look at here, which is your bread and butter chart, and it is the candlestick chart. This is your basic chart that you will always be using. It should be the default chart that comes up when you look at stock charts, and it's the chart that we will be trading from. One of our two, I think, if not our three, in fact, if not both of our trading systems will require you to look at the candlestick chart, and so you want to be familiar with it. It functions just like the bar chart, but the visual of it is a little bit different, and for that reason you get some extra things you can do with candlestick charts that you can't do with bar charts. We're not going to get into all the nuances of candlestick patterns, and a lot of that is available for free in any case online. You can just type in or Google candlestick patterns and study some of the most reliable candlestick patterns there. But let me just scroll in a little bit and show you what a candlestick looks like. Remember this big bar chart, this big long bar that we saw? And it was a green bar where the price was pushed all the way down. Well, this is what that same bar looks like with a candlestick chart. You don't have a knob on left or right indicating your open and close. In order to do that, you have to look at the color of the main body of the candle. That's this rectangular filled in piece of the candlestick. If it is green, then you know that the price point at the bottom of the bar, the bottom of the body as it's called, is your opening price, and the top of the body is your closing price. If the bar is red, then you know that the top of the bar is your opening price and the bottom is your closing price. And then in addition, on the candlestick, you have these little tails at the top and the bottom. You have a topping tail and a bottoming tail, and the bottom tail pinpoints your low of the day, and your topping tail pinpoints your high of the day. So open, high, low, and close, just like the bar chart. The problem with candlestick charts today is that there is something called high-frequency trading, algorithmic computer-aided trading, which is not being done by humans. It's being done by computer-aided technology that is causing a lot of these candlestick tops and bottoms to extend further than they normally would. So we're seeing things that we haven't seen. You know, a lot of this sort of intraday choppiness that you see around here, a lot of that is computer generated trading, and it's making a mess of the ability to read candlestick charts, and it's really making a mess of our volume analysis, because you're getting a lot of extra volume there that really isn't moving the price very much. It's not representing bullish or bearish volume. It's simply the computer taking advantage of very temporary little inaccuracies in the price and very small fluctuations in price and so on. So it's a shame that that's happening. Maybe someday they'll eliminate computer-aided trading. I kind of hope they do. But until then, we're stuck with candlesticks that are a little bit less efficient as far as giving us a read in the market. But with that said, you still have, just like with the bar charts, the ability to take a look at any given time frame and determine whether it is generally bullish or bearish. Generally bullish, you see a lot of green candles. Generally bearish, when you see a lot of red candles. Okay, doesn't mean the market's going down. It just means that we're seeing selling pressure in this area, and what that means is that the likelihood of it dipping down is more than the likelihood of it springing back up again. So I'm bullish the S&P 500 right here because of the trend, because of what we saw in point and figure, but I'm not going to buy it today. I'm going to wait till it gets down here a little bit, you know, down to 238, maybe 237.75. Wait till it dips down to some of the lows of this range, and then I'll buy it, because that's where it's more likely to go than higher in the next few sessions. Okay, so candlesticks can help you with that. And then, just like any chart, if you scroll back, you can get a very good read on the overall trend. You're going to see the pivot highs and lows forming quite nicely. Remember, our rule of thumb is always that the trend channel lines need to be parallel to each other. That's your dominant trend right there going forward, and we assume that that will continue. But our close-up look of the chart tells us that it's probably not going to continue today or next week or the next couple of weeks. We're probably going to have to wait for a little while before it really starts to get bullish again. Okay, so those are the 4 price chart types. Now, let's get back to our PowerPoint here and move on to our next topic, which is various chart time frames. We're going to be looking here at 4 time frames, 4 basic time frames for the price chart, and these are the standard 4 that are used by most traders who do technical analysis: the weekly chart, the daily chart, the hourly chart, and the 5-minute chart. We can draw a line of distinction here between the daily and the hourly chart. The top 2, weekly and daily, focus on either daily or weekly bars of price information, whereas the hourly and the 5-minute chart are what are called intraday charts. They break down the daily price bar into either hourly bits or 5-minute bits. And an hourly chart is a chart where every candle or bar represents an hour's worth of trading, 60 minutes of trading. There are 8.5 hours in a trading day, so you would get 9 bars per day on an hourly chart. And then multiply that times 12 to get how many candles you get in a 5-minute chart per day, because each bar or candlestick represents 5 minutes of trading. You'll get 12 of those per hour. So let's take a look at these charts, and you'll see some interesting things that we can glean from them. First of all, I have all 3 of our moving averages on here, which we will be looking at in a little bit. Let me remove those for now, and we'll put them back. one by one in a little bit, but let's first look at the time frames of the chart itself. Here we have the S&P 500, again represented by the SPY ETF, on the daily chart. And the daily chart is your bread and butter chart. It is the chart that you'll use primarily exclusively for the two trading systems that you'll be learning later in this course. And it is the chart that you'll be using for pretty much all of your trading needs, unless you become a day trader. If you become a day trader, you'll be using the intraday charts, but we won't be worried about that here. On the daily chart, we can see, as we've seen already, that the S&P 500 is in this nice uptrend, a very strong uptrend, with a recent period of price consolidation. Price is more or less moving in a sideways direction between a resistance line that we can draw in here and a support line which we can draw in down here. And we'll talk more about resistance and support lines later in the course. And we can also see that toward the right edge, the price of the S&P 500 is knocking again on this resistance line. And with today's action right here, we're just at the close of trading today. With today's action being bullish and right up against resistance, let's scroll in a little bit, we can see that that resistance line may soon give way. Even though we have a lot of red bars going on in here, which signals some distribution, we nevertheless have a bullish outbreak today, and we're very close to breaking through resistance, which may happen sometime next week. So all of that we get from the daily chart. That's our sort of our bread and butter view right now, right there, of the market. If we go up to the weekly chart, we get a broader view of the market, and you can see that our trading range now becomes a pretty small part of the chart itself. Not insignificant, of course, but it takes on less of a role compared to this giant upward thrust of the market going all the way back to the early months of 2016, which from where I stand right now is about a year and a half ago. So about 15, 16 months ago, I should say. So here we have the same uptrend that we saw before, but now we can see that it's a much longer uptrend. We've been in this uptrend for several more months than we had realized from the daily chart. And this period of price consolidation looks pretty standard compared to this price consolidation right here, this price consolidation right here. This is the third period, and maybe this will include that. The fourth period of price consolidation in this uptrend, and that's pretty much par for the course. You can see that it makes the big thrust up, price consolidation, big thrust up, price consolidation, big thrust up, price consolidation, big thrust up, price consolidation. Rinse and repeat, rinse and repeat. So once we have that pattern established from the weekly chart, then I'm even more bullish than I was looking at the daily chart, because I can see that this is a common pattern that is repeating, and here we are again in a period of price consolidation. My expectation is that sooner or later we will get the big thrust up again to the upside. And I'm going to continue in that understanding until I get a significant break of this support line right here. Let's go down now to the hourly chart, the first of our two intraday charts. And there are a whole variety of intraday charts that you can look at all the way down from the hourly chart, from the 4-hour chart down to the 1-minute chart. But the hourly chart is your standard longer time frame intraday chart that most traders will use. And we can see now that what it's done is it has taken us inside this period of consolidation and has expanded it. So we've lost sight now of that big bullish uptrend we saw in the weekly chart. We've lost sight of that near-term uptrend we saw on the daily chart, and where we're at now in the hourly chart is within this period of sideways consolidation. And we can see it's very, very choppy. Big thrust up, oh, false breakout, back down again, up, back down even further, uh-oh, up, back down even further, false breakdown, yep, that happens. Back up, back down, up, down, way up, and now chop, 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 and we may be getting ready to break out again. This little period of chop, 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 up close to resistance is typically what you see just before an upside breakout. Doesn't always happen. There's nothing ever guaranteed in trading. All we're working with is probabilities, and the probability of this sort of pattern right here up against resistance is likely to break to the up. That's our expectation, likely to break to the upside. If you are watching this webinar anytime in the latter half of 2017, you can go back and check the charts to see if that in fact came to pass. Hopefully it did, because we have a bunch of longs on right now. We'll make some good money if it breaks out to the upside. Now that's the hourly chart. You can see it gives us a very different view of what's going on in the market. We're taken inside what on the weekly chart was just a little blip, right? Not really a whole lot of information right there. On the daily chart was more significant, but now in the hourly chart we can see just how choppy this is. We can also note that there's a big bullish gap right here, a place where there was no trading that took place since then, and a second area of bullish gap right here, another place where no trading has taken place. Now, the traditional wisdom is that gaps will get filled in going forward by price, and they nearly always do. It's pretty rare to find a gap that never fills in. It does happen, particularly at the beginning of new uptrends or at the beginning of new downtrends. You'll get unfilled gaps, and sometimes gaps can take years and years to fill, and sometimes they never do. But because we have two unfilled gaps right here, that tells me that this price consolidation right up here is very bullish, because the bears have not been able to knock price back down into those gaps. But it also tells me that if we were to get any sort of bad news, the bulls would likely skirt out of the way, knowing that gaps tend to get filled, knowing that those gaps are down below where we are now. We may see a very quick fall down into them to fill that gap. For example, you can see there's a gap right here that was unfilled, and there's a bullish gap right here that was unfilled, and this big slam down here filled that gap, and this slam down here filled the prior gap. So you tend to get very hard and fast fills of gaps when some bad news comes out. But right now things look pretty good. Now if we go down to the 5-minute chart, we're going to be taken even further into that price pattern, into that period of consolidation, and we can see now we've lost sight of it altogether. We have to really scroll back on the 5-minute chart to even see where we are. Here's our place of resistance up here at the top. In fact, that's as far back as I can scroll. I can't scroll any further back than that, so we'll have to kind of swipe sideways to see our support line. Okay, now, so what I've done here is with the 5-minute chart, I'm able to go into to see inside of the most recent set of trading data over the last 2 weeks or so. This is about 2 weeks of trading right here. And we can see on a 5-minute chart, it is very, very choppy. No surprise that we get choppiness. But we can see that generally speaking, there's a bullish thrust right now going up into that line of resistance. If we can scroll in on this most recent form of trading right here, and we can even draw, we can draw a little trend line going underneath those lows, and we can draw a resistance line over the top, and that's an ascending triangle, usually a bullish pattern. We would expect that to break to the upside, and it looks like it's getting ready to do that. So those are the 4 basic time frames that you'll get on a price chart. Let's go back to the PowerPoint here. Your daily chart is your bread and butter chart. That's the one you're going to be focusing on. That's the one you'll focus on for purposes of our 2 trading systems that you'll learn later in the course. But it never hurts, as we just did, to go up to the weekly chart to see if you still like it on a bullish basis, to go down into the hourly chart, even the 5-minute chart, to see what's going on under the hood, so to speak, because sometimes something will look great on the daily chart, but you can see on a weekly chart, it's coming into some resistance here. It may not be the best time to buy this stock. Or on a setup you like on the daily chart, but you look down at the hourly chart and you say, you know what, there's some bearish stuff going on here. I think this might not be the best day to buy it. Let's try buying it tomorrow. Those are the kinds of things you can do with this sort of time frame analysis. You don't have to do that, but it never hurts to add a little bit of edge to your trading. Okay, so let's go on then to look at our first technical indicator, the moving average. Moving averages are a very commonly used technical indicator on price charts. Nearly every technical analyst will refer to moving averages in their analysis. They are commonly used by financial analysts as well, fundamental analysts who will only glance at the price chart now and then, but they nearly always talk about the moving average of price when they do that. So very commonly used technical indicator, and very practical and helpful for us in determining the health of a trend in the stock or the index. Let's take a look at moving averages on our price chart. So we'll get back to our standard price chart here. We have the S&P 500. Trading has closed, by the way, today, and we did just get a little peek above the resistance line of the S&P 500. So that little breakout that we were looking at as a potential did take place, but it really needs a good another 20-30 cents of upside above this prior intraday high back here to confirm that breakout. So let's place some moving averages on our chart. We will skip down to moving average. And first thing I want to show you is that there are a couple of different types of moving averages. There are, if I can find it here, I guess it's under moving average exponential and moving average simple. We're going to use a simple moving average. The exponential moving average is simply one that is a little more responsive to current price action by the way it's weighted. We don't have to worry about that. Exponential moving average factors into one of the technical indicators we'll use, the MACD, but we will not be overlaying it on the chart. We're going to go with a simple moving average. We're going to place 3 moving averages on the chart. So we will click this technical indicator moving average 3 times. 1, 2, 3. And that places 3 on our chart. Now they're all set at the standard default periodicity of 8. What does that mean? That means that we're looking at this line right here. This black line is an average of the closing price over the last 8 days of trading. 8 days is a little too short term for us, so we're going to open up the format box, and under the input tab we'll change 8 to 20. That's our shortest time frame. And then we're going to go into the second moving average and change the 8 to 50. That's our medium term price range, time frame. And then under the third one, we're going to change 8 to 200. That's our long-term time frame. So now we have 3 moving averages on the chart: the 200 period, the 50 period, and the 20 period. The 20 period should be the one that is easily spotted because it's closest to the price overall. The 50 period is a little further away, and the 200 should be the furthest away. The 200 period moving average is a very standard moving average. It correlates, roughly speaking, to about a year's worth of trading. There are about 250 days of trading in a year, so it's not quite a year, but it's close. I don't know why 200 instead of 250, but that's just the tradition. We use 200. And frankly, 200 is often a place where once price pulls back into it, it gets bought. Once price pulls into it, it gets bought. So anyway, more about that later. So we have the 200 period moving average. We have the 50 period moving average right here, which correlates, roughly speaking, to about a quarter's worth of trading. There are 60 days in the quarter, 60 trading days in the quarter, 62, 63 trading days in the quarter. I don't know why it's that number instead of something higher, but it is. It's 50. And the 50 is a very good intermediate term moving average for us. And then we have the 20 period moving average up here, which stays pretty close to price. It will follow price quite closely. and it correlates to roughly a month's worth of trading. So month, quarter, and year, we have represented here the average price over that time frame. We have represented in the endpoint, the very far right edge of the moving average. Now, several things we need to focus on when we have moving averages on our chart, the very first of which and the most obvious of which is the slope of the moving average. Is it sloping up or is it sloping down? When we can see that off to the very far right edge of the chart, all three moving averages are sloping up. The 20-period moving average has been sloping up for about 2 weeks. The 50-period moving average has been sloping up in this chart constantly, and the same with the 200-period moving average. This tells me that we are in a long-term uptrend, a medium-term uptrend, and a short-term uptrend. Got it? Very easy. Long-term, medium-term, short-term. Now look at what happens when we have something like this. The 200-period moving average is sloping up just slightly, but it's sloping up nevertheless, long-term uptrend. The 50-period moving average up in this area right here is pretty flat. So what we would have to say is that according to the medium term of our trend at this point of our chart, the medium term time frame, we're looking at a flat market, neither bullish nor bearish. In the short term, we're looking at a bearish market. It's a downturn, a downtrend. The market is trending down in the near term, which it did actually carry down all the way down into the 200-period moving average, where it then pushed off quite sharply. In this period right here, long term, medium term, short term, all up. Now, this is interesting here because we have long-term range pretty flat, flat to up, flat on the left side of the chart, up to the right side of the chart. The 50-period moving average is up to the left side of the chart and still up, takes a little dip, but still up pretty much for the most part of that whole period. The 20-period moving average, however, is your schizophrenic average. It's up early on, and then it's down, and then it's up, and then it's down, and then it's really up very sharply. So what that tells me, just eyeballing this period of trading right here, we have a flat, indecisive long-term market, and we have a lot of market confusion in the intermediate and short-term time frames. So not a good place to be putting on long-term positions. Let's wait until we get something that looks more like that, not this. Now here's an interesting one. We have the short-term range is up sharply. The medium-term range has just turned up and is now turning up sharply, but our long-term average is very flat. So this is a great market right here to put on some short-term trades on the bullish side, but maybe not some long-term position trades. Okay. So that's what we are looking at with the moving averages. We can use them to determine long-term, medium-term, and short-term bullishness or bearishness of the market itself. The other thing we want to look at with moving averages are the crossovers, whenever one crosses over the other. When a short-term moving average crosses over a longer-term moving average, we have a point of information that tells us something about the market. When the 20-period moving average crosses under the 50-period moving average from above, that point right there, we have to say, we're forced to say that at that point in the market, right there at the right edge, we're looking at a market that is turning decisively more bearish. Now, that doesn't mean it's going to be bearish, because look what happens. It actually keeps going up from there, and that happens. In the 20-period moving average right now, as of today, it looks like it just crossed over. It did indeed. 2 points higher, 2 cents higher on average, the 20-period above the 50. So we have a bullish crossover again. But at that point right there, our best guess, our most educated guess going forward, is that we're entering into a short-term bearish period for the market because of that negative crossover. Here we have a bullish crossover of the 20 over the 50 from below. So from that point on, we're saying we're now moving back into a bullish period of the market. Now that's an indicator that did pan out quite strongly, quite decisively over the next few months. We had very bullish action in the market. So that's a short-term crossover because the 20-period moving average is a short-term indicator. Here we have a bearish crossover that panned out pretty nicely because the general tone of the market from that point on was pretty bearish for several weeks. Remember, these are short-term signals. They're not 100% accurate by any means, but they do give us a short-term read in a probabilistic way of where we think the market is most likely to go over the near term. Now, we still don't have a good medium range crossover until we get down to here. This is a bullish crossover of the 50 period over the flat 200 period. This is actually what technical analysts call a golden cross. The golden cross is understood to be a not 100% accurate signal by any means, but it does mean that from that point on going forward, you are in a decisively bullish market period because your medium-term range trend is now higher and stronger than the long-term trend. And that means that the price going forward over the medium term should be strong, should be bullish. And indeed, overall, okay, you had some exceptions, but overall, the market was pretty bullish going forward from there. And of course, now we're up to new highs. In fact, way up to new highs, right? Right up there. Look at that. 240. Okay. So bullish, bullish golden cross right there. Here's a short-term cross. Here's the longer-term cross. Now, look at this. Very interesting. 3 crosses right in a row. All 3 moving averages converging. The 200 granddaddy moving average is very flat. The 50-period moving average right here, this lower one, is going up and now going back down again. Going up, going back down again. We have a bearish cross right here of the 50 and the 200, and that's called a death cross. Very dark name, but that's what it's called. It's called a death cross because technical analysts consider that from that point going forward, we're looking at what could very well be a bearish period for the market over the intermediate to long term. Not a good place to be putting on new trades, but nevertheless, yes, indeed, it panned out for several weeks at a time, but then we had this double bottom down here, and that was about all that the bulls could stand before they jumped up to the plate, began scooping up bargain shares, and pushed the markets quite a bit higher. You don't want to just buy the market on a golden cross and sell the market on a death cross because you will go for years in a row of losing money. But they are things that you want to pay attention to. They do tell us the overall health and trend of the market. It's pretty rare for you to open up your stock chart and immediately see on the first day that you look at it a death cross or a golden cross, because they don't happen very often. Sometimes once a year, sometimes once every couple of years. But when they do happen, it's a wake-up call. And it's something to pay attention to. More importantly, for our purposes, is to note where the 3 moving averages are in relationship to each other. Your most bullish scenario is when all 3 moving averages are in their proper order. Sorry, this is a little buggy right now, but in their proper order means the 20 is above the 50 is above the 200, and all 3 are moving up. That's the most bullish scenario you can have according to the moving averages. The most bearish moving average scenario is the 20 below the 50 below the 200, and all 3 are moving down. That's the most bearish scenario. Keep in mind that the market likes to reverse on extreme conditions. So when we see the most bearish market scenario possible, that is the time you should start to think about buying stocks. And when you see the market in the most bullish scenario possible, that's the time you should start to think about taking some profits off the table. Not necessarily shorting stocks. I only advocate shorting stocks in a bear market. But in a bull market, when you start to see the most extreme forms of bullish indicators from the moving averages, that's a time to start to think, things are probably going to start to cool off fairly soon. Let's take a little bit of profit off the table. Now, the third thing to look at with moving averages, not only the slope, not only the crossovers, but the third thing to look at is relationship of price to moving average. It's pretty common, because it's a shorter term moving average, for price to move up and down, above and below the 20-period moving average. And it can move below the 20-period moving average, and we can still say this is a bullish market. And it can move above the 20-period moving average, and we can still say this is a bearish market. It's fairly common to see moves above and below the 20-period moving average. But what we are interested in is when price gets far away from the 20-period moving average. The moving average then will act as a kind of magnet for the stock price itself. It has no power over price. It can't pull price into itself. But because averages are what they are, if the current price moves very far away from its average price, statistically speaking, it will very likely make a counter trend move back into the moving average. And that's particularly true when the price is moving away from the slope of the moving average. So if a moving average is in an uptrend and we see price move very far away from it, here we have the 20-period moving average in an uptrend, a short-lived one, but an uptrend nonetheless. And down here we have price very far away from the moving average. Moving average up here is around 209.50, and the price down here is at 199.40, and that's a very significant move away. We expect price to shoot back up, to snap back, as I like to call it, back into the mean. So if you are bearish the market, you don't want to short it down here. In fact, you might even want to buy a few shares of the spiders or whatever stock you're looking at when you see this sort of thing. Upward sloping 20-period moving average, price very far away from the moving average. Buy a few shares and expect to snap back into the average. Let's see if we can find some other places here. Now here's a down sloping 20-period moving average, but even when price gets far away from the down sloping moving average, we still expect it to snap back up into it. Price is far away, snaps back up into it. Price gets too far ahead of the moving average, snaps back down into it. Price gets too far below the moving average, snaps back up into it. Too far below the moving average, snaps back up into it. Okay, and that's true for all three moving averages. The difference is that your 20-period moving average is your short-term moving average, your snapbacks. So here's a 20-period way up here. Price is way down here. The snapback happens very fast with respect to the 20-period moving average. If you're buying something because it's very far away from the 200-period moving average, you might have to wait months, maybe even a year or so, before you see it snap back into the 200-period moving average. I prefer to trade the shorter term moving average in terms of these snapback. Now I have a whole trading system based on that idea. It's called the reversion to mean, or the mean reversion trading system. And I sell that manual, the trading manual that describes that system, on our website, drstocks.com. And it's also included in my third book, Market Neutral Trading. If you're interested in that particular system, then you'll find all the details there, all the parameters there for that. It's a very powerful trading system. The only problem is that sometimes it doesn't work out, and when it doesn't work out, the losses can be quite spectacular. But nevertheless, look at this one. Here's another good snapback. Way away from the moving average, snap back up into it. Okay, so those are the three things we use the moving average for. Let's go back to our PowerPoint and move on to the next technical indicator, which is trend lines. Okay, back to our chart. And we will remove all of the indicators here, remove all indicators, and scroll out. Let's go forward. Okay, so this is a good chart actually to use for plotting trend lines. Trend lines, as the name implies, they are lines that are drawn over a price chart to indicate the dominant trend, either up or down, of the market itself. Clearly, in this chart, over this time frame, we are in an uptrend. And your rule for drawing trend lines is that you want to include as many touch points as possible within the time frame that you're looking at. Now, if I scroll in to look at this chart, for example, then I'm going to draw a different kind of trend line because I want to include, let's try this price point down here. And that gives me 1, almost 2, 3 touches right there. Alternatively, I could put the trend line here, and then I'm looking at 1, 2, almost 3, almost 4, 5, 6, 7, 8 touches. So that's either one is a good place to put your trend line, but because I have so many more touches right here, this tells me that this is your dominant supporting trend line. We call it a support trend line because it's the one on the bottom. When price pulls into this trend line, our expectation is that it will push back off to the upside. Now, there's no magic in that. It's not that price has to push off when it gets into that trend line. There's absolutely no, objective reason why price will adhere to the support line. It doesn't have to at all. And of course, as you know, trading on the exchanges is a facet of all kinds of different inputs, fundamental inputs, geopolitical inputs, psychological inputs, economic inputs, and of course, the things that are going on with the company itself and the companies of an index all factor into the balance between demand and supply, between buying and selling on the exchanges, and all of that then determines where the price is going to go going forward. The trend lines have nothing to do with it, but what the trend lines are marking is they're marking the edges of that battle between the buyers and the sellers over the most recent period of time of trading. And our expectation is, and our studies indicate that this is a reasonable expectation, is that those lines of battle will pertain going forward. They will be sustained going forward. So that's a very good reason to draw in trend lines because since price kept pulling down into this increasing upsloping trend line and kept pushing off in the past, we expect the same thing to happen in the future. Okay, so that's my justification for using trend lines. Now, you're drawing them in an uptrend. Here are the rules. When you're drawing them in an uptrend, you always start with a support line first. You can have an uptrend with rising support lines, with rising lows, these little low pivots here. As long as these lows are getting higher and higher over time, that is an uptrend. It doesn't matter what's happening up here at the top of the chart. It only matters what's happening down here at the bottom of the chart. As long as I'm seeing rising lows, I'm considering this to be an uptrend. So we always start with a support line if it's in an uptrend. Then the rule for drawing in your resistance line, which is your line that's going to cover over the top of this trend, is that it has to be parallel to the support line. Every trend channel is what we're calling them when you have the two lines drawn in, is a parallel channel. Both lines have to be parallel. So we're going to put in our resistance line over this highest peak right here, this highest high, and then I'm going to just sort of fiddle with it until I can kind of eyeball it as being in parallel to the support line. Now, there is a tool you can use to make sure that these lines are exactly parallel, and we're not going to use that tool here. It's called you can use this pitchfork thing, but we won't worry about that. We'll just draw it by hand, which I prefer to do anyway. Now, if I wanted to, I could extend this trend line down a little bit further to include that low right there, which gives me almost a touch point here. It still retains these touch points up here. And then I would just have to adjust my resistance line a little bit to make sure that it's parallel. And if I scroll back a little bit further, I would maybe want to include this line down here, this very deep cut low, raise this up, and then I have to fiddle with my resistance line a bit, and that puts my resistance line right about there, which includes that touch point. And we raise this a little bit. There we go. So we have two kind of trends going on here depending on the time frame that you're looking at. In a little longer time frame, we have a very steep uptrend. We saw that before in the weekly chart, remember? In terms of a closer time frame, we'd have to say that, you know what, our trend is actually getting a little less steep. It's beginning to slow down a little bit, and therefore it is losing some of its mojo, losing some of its momentum. But it's still a really nice looking uptrend. Okay, so we have two trends going on depending on the time frame that we're looking at. Longer term, very steep. How did we get there? Somehow we messed that chart up. In any case, shorter term, not quite as steep. But here's one thing I want to show you. Let's remove all these trend lines. And I don't know how to narrow that chart, but anyway, if we take our trend line and instead of doing anything with the chart, we simply put it on the chart, overlay the chart itself from corner to corner, from southwest corner to northeast corner. That's, of course, a 45-degree angle. And one of the things that we can do with chart analysis is that we can determine whether this trend is conforming to the 45-degree angle, which is your most sustainable and robust form of trend. 45 degrees is a perfect trend angle, and anything greater than 45 degrees is going to be too strong, too hot, too much momentum, very likely to crash. And anything less than 45 degrees is certainly sustainable, but is going to be a rather weak trend and one that would take longer to make money in because you're going to have to wait longer for the price to rise. Your best, most sustainable, most robust trend in any stock or index is one that's set at around 45 degrees. Sorry, I had to fiddle a little bit with the chart to get it to correct itself, and we're okay now. So we have here the daily chart of the S&P 500. We put in this 45-degree angle, and what I want to determine now is whether the trend that we have listed here, this is about a 12-month trend, about a one-year trend, is roughly at 45 degrees or not. Or is it stronger than 45, or is it weaker than 45? I can, without even drawing in trend lines over the price, I can just eyeball this and tell that it's very, very close to a 45-degree angle. You can see that the price chart itself hovers around the 45-degree angle, both above and below. That's healthy. You want to see that. It always comes back into the 45-degree angle. It stays along the 45-degree angle. It never gets too far away, either onto the upside or to the downside. That's all very healthy stuff. That's sustainable stuff. That's the kind of healthy trend that you'd like to see. If we draw in our trend lines, if that's our dominant trend, and it may well be, then we're looking at something that is a little weaker than 45 degrees. Do you see how that's weaker than 45 degrees? I have a feeling, however, that that's not our dominant trend, that our dominant trend right now going forward is this trend right here, because we are starting to see some pickup in momentum, and that is slightly stronger than 45 degrees. Now it's not that much stronger than 45 degrees, so I'm okay with that. I'm not going to call that an overly heated trend, but it is one that is certainly increasing in momentum. All of that is to say that the ideal trend is at 45 degrees. A little bit less than that is going to be a slower trend to work with. One that's stronger than that is one that is likely to get overheated too quickly. And we have something that looks more like about a 50-degree trend here. So a little bit of a concern, but not really that much going forward. I suspect what's going to happen is that at the next pullback, we'll get a low that reestablishes a trend at around 45 degrees. Because if we look at this resistance line up here, that's almost parallel to your 45-degree trend. And if we were to take this support line and extend it back, we would see that, you know, a lot of the touches we get on the south side of this trend are roughly parallel to the 45-degree angle as well. So I'm not too worried about this trend, but I'm just showing you some ways in which you use trend lines to determine not only the trend itself and the area of price containment that we would expect going forward, but also the health of the trend, how robust it is. Now let's look at a downtrend if we can find one. There hasn't been any real good downtrend for quite some time. Everything's up, 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 up. You can see a lot of good, healthy 45-degree trending action here. Sometimes more than that. Here we go. Having to go all the way back to 2008. Well, okay, this is the major market crash, right? This is the really bad market, 2008, 2009, big time downtrend. But in a downtrend, here, your rule of thumb is that you always start with the highs, the high pivots, and you put your trend line indicator over those highs, and then you would put your support line under as many lows as you can, but always in a way that is parallel to the resistance line. And that's a very wide-ranging trend, not something you want to see if you're long the market, because that's kind of a scary thing. Now, on the upside, once it did finally break in 2009, if we extend this out to something like that, then we can see that it ran into resistance and balked there for about 3 weeks in a row as it was fighting against that resistance, and then it really broke out 2009. This is the low back here in March of 2009, but this is the break of the downtrend and the resumption of the bullish uptrend in the latter half of 2009. Really strong run altogether. Okay, so again, on the downtrend, start with your resistance line at the top, put in your support line down below, and if you want to check the 45-degree angle, you'd have to say that this is a little bit less than 45 degrees, which is a sustainable downtrend, but it's going to be a little sluggish going forward. Now, it wasn't sluggish. It wasn't very sluggish for those who were short the market in this period right here. I mean, that's a slam, but that happens. But just to let you know that 45 degrees is the best sustainable form of trend going forward. When you see this kind of thing going down, that's not sustainable. When you see this kind of thing going up, that's not sustainable. When this kind of thing going down is not sustainable, that's more than 45 degrees, that's not sustainable. But this kind of thing right here, that's what you want to see. That's a beautiful uptrend right there. Nice 45-degree angle. And your trend is your friend until it ends. And it doesn't end until right about there. And it went back up again. And then it just got choppy. Okay, so that is our technical indicator trend lines. Back to our PowerPoint. Our next technical indicator, very easy to look at, support and resistance lines. Back to our chart. Now, we've done trend lines, and that's a little more of a sophisticated look at the market. Support and resistance lines are a little different. Trend lines are always at an angle. Support and resistance lines are always horizontal. So, very easily seen on this chart is the resistance line, which is right up here. We've looked at this several times already. Perfectly horizontal line, and we have one touch, we have two touches today, and we have two very near touches, one last week and one a few weeks ago. So that clearly this horizontal line is our resistance line. Does that mean that price will back down from it and pull back? No, it does not. All it means is that over the last several months, three months altogether, several weeks of trading, that has been the line in the sand. Trading has not managed to close above that line. If it does manage to close above that line this next week, which I expect it to do, then that is a very important piece of information. It doesn't guarantee that price is just going to keep going up from there, but that's called a breakout, and it will in fact be a breakout to new all-time highs, and that's the kind of thing you want to see in a healthy bull market. Now, your support line is, again, a horizontal line, so it's always going to be parallel to your resistance line, always, because horizontals are horizontal, right? And the same rule applies. You just want to set this somewhere underneath your lowest closing pivot low. We came very close to it here. Got slammed down, closed at the very low of the day, looked pretty bearish, because price had already gone way up here and pulled back down. That was a very ugly red stick kind of day. And then it got slammed down here, and the bears are thinking, yeah, this is finally the big short that we're looking for in this market. And of course it wasn't to be. 2 to 3 weeks later, it's back up to test the resistance point. So that's the power of support. In general, you want to buy at support, and you want to lighten your longs when you get up toward resistance. It doesn't mean you want to sell out altogether, because breakouts happen, and when they do, that's very bullish. But if it starts to pull back from resistance and then starts to head south, then that's a good sign that resistance is holding here for now, and we want to lighten our longs. Let's see if we can find some more resistance lines. Here is a classic set of resistance lines right here. We have the containment for 1 week, 2 weeks, 3 weeks, 4 weeks in a row. Can't get past what is that number? About 228. Can't get past 228. Keeps tagging that number. Can't get up there. And then suddenly it gaps up above. Now that gap had to be closed, so it closes the gap a few days later. Again, trades around that resistance point, and then it's just off to the races from there. Clear line in the sand that traders and investors are keying on, and every time it gets close to it, people are either buying or selling. A lot of activity takes place right around that line. Very important line, because everybody's looking at it. Your support line only has one touch down here, and it never got down there. It only got down there once. So really, this is a very bullish period in the market, even though it only went sideways. That's called bullish consolidation. If the market was consolidating down here around the support line, that would be bearish consolidation. Bearish consolidation, we would expect a break to the downside. Bullish consolidation, we expect a break to the upside. It didn't happen overnight, right? You had to sit through 1, 2, 3, 4, 5, 6, 7, 8 trading days before you finally got, and then even a couple more sideways movements. 11 trading days altogether before you finally got a good run higher. But that's the waiting game that you have to sit through as a trader. So more areas here. This is that horrible summer period of consolidation that was just the bane of everybody's existence during the pre-election months heading into the November election 2016. But the nice thing about this is that there were some very clean lines in the sand. You had your resistance line up there. You had your support line down here. And for many, many weeks, those were the lines in the sand. You had some intermediate there's a nice resistance line that got broken to the upside, and here's another resistance line that held sway. Now see this sort of bearish consolidation down here where you're consolidating down near the support line. You would expect that to break to the downside. We expected this to break to the upside. It didn't. And, that happens. We expected it to break to the upside here, all this knocking up on resistance. It's bound to break sooner or later, and it did. It just didn't get very far. We would expect this to break to the upside, and it didn't. So, there's no hard and fast guarantee in trading. All we're doing is working the probabilities. But we did see this break to the downside very briefly until the night of the election. Investors loved the results, and the market has been in a rally ever since then. The other thing to realize about support and resistance lines is that in general, and this is a very broad generalization, a resistance line, once it's broken, will tend to act as support going forward. A support line, once it's broken, will tend to act as resistance going forward. That's not always the case. Let me see if I can find some areas where that is the case. But it does happen more often than you might think. So here's a kind of a line in the sand on this double bottom. There's one bottom, back up, resistance, second bottom, back up. A break of resistance took a few days to kind of clear out some of the overhang. And then it's off to the races. Oh, we didn't quite get very far. We're back down. We come close to this resistance line again. In fact, maybe we can move that up a little bit to include these highs right here. And you can see how it would act as support on any pullback into that support line. Formerly resistance, now support. Back up again. Formerly resistance, now support. Back up again. Formerly resistance, now support. Back up again. Until it's broken. And then, of course, that happens. So we have a trend line going on here. There's your resistance trend line. But if you want to look at a resistance line, you'd have to draw it in a horizontal fashion, which is that up there. Okay. And that actually held forward going into that little area of consolidation. And you've got your support lines drawn there. We have a little bit of a breakout. It was a head fake. We have another little head fake down here. This is just all very confusing market action, but very typical, pretty typical of what happens. So anyway, that's how you deal with support and resistance lines. And the key things to remember here is that they're always parallel. You try to draw them through as many price points as you can, those pivot highs and pivot lows. And once they're broken, they do tend to act then as just the opposite. Resistance becomes support, support becomes resistance. Okay, back to our PowerPoint. On to our next topic, which is the MACD indicator. Now, we aren't going to say a whole lot about various chart time frames because for the purposes of this webinar, our only focus will be on the daily chart. That's our bread and butter chart. But I just want to orient you a little bit to the variety of time frames that you can work with when you're working with price charts. And it's never a bad idea. Even though you're working with the daily chart, you're trading from the daily chart, you're searching for stocks based on the daily chart, it's never a bad idea to grow up to a larger time frame to see what's going on there, and to scroll down to the next nearest time frame to see what's going on there. And let me show you what I mean in just a minute. So of the various time frames that are available to you in most charting packages, the most commonly used chart time frames are the weekly chart, the daily chart, the hourly chart, and the 5-minute chart. We have to draw a line of distinction right here to separate the hourly and 5-minute charts from the daily and weekly chart, because the latter two chart time frames are what are called intraday charts. Intraday meaning that they look within a single day of trading and they break down that single day into smaller bits, where each bar or each candlestick on the chart represents not a full day of trading, but a subset of that day, either on an hourly basis or on a 5-minute basis in the case of the two charts we're talking about here. the daily and weekly charts are not intraday charts. They are something else. There's not really a good name for the opposite of an intraday chart. There's simply the daily chart and the weekly chart, and you can go up to the monthly and even the yearly charts as well. But for the most part, the daily and the weekly are the two non-intraday charts that are used the most. But as I said before, the daily chart is your bread and butter chart. That's the one that you're going to be focusing on. That's the chart time frame that our two trading systems that you're learning here in this webinar will be using. But just to orient you a little bit, let's take a look at these intraday charts, and you can see what extra capacity they add to your trading. So let's get back to our chart, and here I have, instead of the S&P 500, I have the Dow Jones Industrial Average as represented by the diamonds, the DIA ETF, which is the ETF, the exchange traded fund representing the Dow Jones Industrial Average, the 30 largest cap stocks trading on the U.S. Stock Exchange. And this is the daily chart, again, your bread and butter chart. And what we can see most evidently on this chart, as we have it framed here, are two large, very strong thrusts upwards from around 189 to 199. A 10-point move. Then we have this sideways period of consolidation followed by a second strong thrust up, ending with a gap up, which was kind of the cap on that move. And then we've had this multi-week downtrend here, minor downtrend followed by a double gap up. And we can look at this whole period here as a period of consolidation. It's actually rather bullish consolidation. Or we can look at it as a failed downtrend. It was a failed attempt to try to take this average down. News intervened, earnings intervened to cause this double gap up here, and that's where we are today. Today we're up near new high territory. So this is the daily chart, and if we were to draw in our trend lines, we would do something like that with our parallel line, of course, over the top of the highest high, and that's our dominant trend on the daily chart. Now watch what happens to this view when we go up to the weekly chart. And the way you do that in TradingView, similarly to other charting packages, is that you would find your time frame tab, and you can see the variety of possibilities I have here for time frames, going as long as 1 month per bar. 12 months per bar, 1 year per bar. So that would be an annual chart. The monthly chart, the weekly chart, the daily chart is one we're on. And then on an intraday basis, you can see the dividing line right here. I have these options: 4-hour charts, 3-hour, 2-hour, 1 hour. That's your primary intraday chart. Going down to 45, 35, 15 minutes, 5 minutes, that's your primary day trading chart. So most day traders will use the 5-period moving average. And I can even go down to a 3-minute or a 1-minute chart. So let's go up to the 1-week chart and see what happens in terms of our view. Here's that dominant period of activity that we were looking at on the daily chart. We can see that that is a very strong uptrend channel. We can see the 2 periods of consolidation. But it really looks very different now because it is only a piece of a much larger picture, which is this very large uptrend that we see having formed here. Slightly different angle, and that's okay. Where would we put our... Remember, this needs to be parallel. That's our rule of thumb. Always has to be parallel to the support line, which is the one you establish first. We can kind of bring it in pretty close to those highs, and that's our dominant uptrend. And we can see now this dominant uptrend goes all the way back to January, February of 2016, and we're now in the middle of May 2017. So it's been almost a year and a half that this uptrend has been in evidence. We had 1, 2, very small, and we're currently in a 4th period of consolidation, price consolidation, with the expectancy that we're going to break out to the upside. So we get a broader view, but it's also bullish. So having said that, if you liked something on the daily chart, you go up to the hourly chart. You like something on the daily chart that's bullish, you go up to the weekly chart, and you see that the weekly chart is also bullish, that is all the better. If you like something on the daily chart that's bullish, you go up to the weekly chart and you start seeing things that look a little bit questionable. Perhaps price is coming into an area of resistance, or perhaps you're starting to see the downtrend form. Then you would maybe want to back off of that trade. It wouldn't be nearly as probable a profit for you as one where both the daily and weekly were looking quite bullish. Watch what happens now with this very big picture when we go down to the hourly chart. Now we're looking within the range of 1 day. First, let's go to our daily chart so we get a comparison, a better comparison here. And remember, this is our dominant period of activity here with these two big thrusts up and these two periods of consolidation. Let's just remove these trend lines for now. They're not relevant. And so that's your dominant view of the daily chart. When we go down to the hourly chart, keep your eyes on this area of price activity right here, because that is going to be your primary focus on the hourly chart. And boom, we can see we're taken right into that period of consolidation. We've now broken down the daily bar into 9 hourly bars. There's actually 8.5 hours in the trading day from 9:30 a.m. to 4 o'clock p.m. Eastern Standard Time. And that gives us 9 hourly bars. So I don't know whether the first hour or the last hour is the half-hour bar. It doesn't really matter, but in some charting packages, the first hourly bar goes from 9:30 to 10:30, and in some hourly packages, in some trading packages, charting packages, it goes from 9:30 to 10, and then every hour on the hour, you get a new hourly bar. You'll have to figure out, depending on the charting package you use, what is the case. Now, I use actually TradingView for my my hourly chart day trading system, and it counts the last half hour as the last hourly bar. So it goes from 9:30 a.m. to 10:30 a.m. before you get the second bar. But it'll vary from charting package to charting package. So probably a good idea to figure out if you're going to be trading the hourly chart, you need to know that, whether it's the first hour or the last hour that is the half hour bar. But in any case, you can see how we're taken now into that period of price consolidation. You can see these 3 very clear, distinct periods of movement. This consolidation right here on the left, the one down here at the support line in the middle, and now the one up near the resistance line again on the right-hand side. And we're at this far right edge. It looks like we're about to break through again to the upside for new all-time price highs, or at least a test of the previous all-time price high on the Dow Jones Industrial Average. That's the hourly chart. It gives us an expanded view of what's going on in a narrower range of trading activity than the daily chart. Watch what happens when we go down to the 5-minute chart, however. So we're taking each hourly bar and breaking them down by 12. So there are 12 5-minute bars for every hourly bar. Multiply 12 times 8.5, and you'll figure out how many 5-minute bars you'll get on a daily chart per the 5-minute chart. And you can see that we're taken now into the only activity we're taken into is that far right edge, that sort of nice cup up near the resistance highs of the much longer multi-week period of price consolidation. So if we scroll way back as far as we can go, we can start to see that period of consolidation. That's as far as I can go back. But you can see that whole period of consolidation is here, more or less, on the 5-minute chart. But what we get primarily, I mean, our best close-up view, our standard view, is just sort of the far right edge of the far right edge of the far right edge consolidation that we saw on the daily chart. So it's kind of a fractal view. So you get the same patterns recurring and repeating as you go down into the intraday charts, and as you go up toward the weekly charts, you'll see these same patterns recurring again and again. It's just like taking your chart and putting it under a magnifying glass and then putting it under a microscope, and then perhaps turning it all around and looking at it, in a very expanded view. In any case, I'm not very good at analogies, so we'll just move on from there. So let's get back to our PowerPoint. I just wanted to give you a quick view of how to look at these different time frames. But again, our bread and butter chart for the purposes of this webinar is the daily chart. Okay. Our next topic is technical indicators. We're now going to start looking at a variety of technical indicators, and we're going to start with the most commonly used technical indicator of them all, and perhaps the one that's the most effective in terms of determining what's really going on in the chart, and that is the moving average. The moving average is, as the name implies, an average of closing prices. It's by default pegged to the closing price of each day, and you can change that if you want. You can change it to the open or the high or the low, but I would always recommend using the default closing price. So it's the average of the closing prices of a stock or index or ETF over X number of days. So you can have very short-term moving averages of 3 or 4 or 5 days of trading. It's an average of price, closing price, over the last 3, 4, 5 days. You can have very long-term moving averages, 200, 300, 500 days if you want. But it's always the average of the closing price over those period of days. So every time you have a new day of trading, the very first number in that sequence is dropped off, and the new price point, the new data point, is averaged in to the moving average. Now, there are different kinds of moving averages. You have simple moving averages, you have exponential moving averages, you have weighted moving averages. We're not going to worry about the different types. For our purposes, when we talk about a moving average, with one exception, when we talk about the indicator MACD, we'll be talking about simple moving averages. Sorry, I didn't mean to click that. Simple moving average is simply the simple average of closing prices over X number of days. An exponential moving average, which is the only other moving average we will mention in this webinar, is a moving average that gives extra weight to the most recent data point, to the most recent closing price, which makes it a little bit more responsive to what's going on right now in the market. But we're not using that. We're using simple moving averages. So let's get back to our chart and let's see how moving averages work on a real chart. So let's go back to our daily chart, and we'll stick with the diamonds for now. Not a bad place to be. Let's get rid of these trend lines, support and resistance lines here. And let's overlay the 3 moving averages that are most commonly used, the ones that I use myself, the ones that are used by all market technicians and certified technical analysts, and the moving averages that, in fact, those that don't like technical analysis will refer to sooner or later. And that is the, here we go. So 3 moving averages. We're going to look at the 20 period, the 50 period, and the 200 period. To put these on the chart, you simply click 3 times. 1, 2, 3. And then you'll have to go into the little Format tab and change the input number. Instead of 8, which is the default, and I don't know why, because it's not very commonly used, we're going to put in 20. And we're going to put in, instead of 8, 50. And then instead of 8, we're going to put in 200. Okay, so we'll click on that. And there we have our 3 moving averages, the 20, the 50, and the 200. Now, with these averages in place, let's move back a little bit. With these 3 averages in place, there are several things that they will tell us about the chart that we can't really get from the price alone. I mean, we can, but the moving averages act as confirmation of what we're actually seeing in the price. And the fact that these averages are including price points that go way back even beyond what we have here in price is to our advantage, because then the moving averages are giving us a much broader picture of the chart but because they also appear here in the far right edge, they're giving us information based on past history of what the market is actually doing right now. And all of that's good stuff, okay? So the first thing we want to look at with regard to the moving averages is the slope of the average. Is it sloping up? Is it sloping down? Or is it something in between that is more like a flat line rather than anything sloping? You will get moving averages that slope just slightly up or just slightly down. And to my mind, that's pretty much of a flat moving average. When it is sloping like this very clearly, so it's much higher from the left-hand corner to the right-hand corner, going from left to right, it's higher here at the right edge than it is at the left edge. That is an upwardly sloping moving average, and that, of course, is a bullish thing. So our 200 period moving average is bullish. Our 50 period moving average, it starts off pretty much flat here on the left side and then really picks up from there. Picks up very much from there, and it's upwardly sloping at an even sharper angle than the 200. So that tells me that the 50 period moving average is bullish. And then the 20 period moving average, which is always going to be your most volatile moving average because it's closest in relationship to price, to current price, is, as we would expect, choppy, but nevertheless, from left to right is in a bullish posture, right? It's slightly down and then it's sharply up. It's flat, it's sharply up. It's slightly down, slightly up. All of that, however, resolving to the upside for the most part. From left to right, we're in an upward posture for all three moving averages. This tells me that the stock that we're in, the stock we're looking at here, in this case the Dow Jones Industrial Average, is in an uptrend over the short-term time frame. That's the 20 period moving average. The intermediate term time frame, that's the 50 period moving average, and the long-term time frame, which is the 200 period moving average. All three of those are indicating we're in a bullish posture. That's, of course, the best of all possible worlds. By the way, the 20 period moving average is, roughly speaking, about a month worth of trading. The 50 period moving average is, roughly speaking, about a quarter's worth of trading if you subtract weekends and holidays, and it's a little bit less than a quarter, but it's close. The 200 period moving average is almost a year's worth of trading. So those three numbers, while not exact, they make some sense in terms of why those numbers are chosen. Why it's not 22 and 60 and 250, I don't know, because those are much closer to the monthly, quarterly, and annual days of trading. But in any case, we'll not worry about that. So the slope of the moving average determines the bullish or bearish read of the chart. And right now, in terms of this whole picture, we're looking at a very bullish chart. And if we scroll into the what's going on more recently, we're also still in a bullish posture. All three. 200 is moving up, the 50 is moving up, and the 20 is moving up. Let's see if we can find a period where things aren't quite so bullish. And this is a very different read of the chart, isn't it? Right here. We'd have to say that on the left-hand side of the chart, we have a bullish 20 period moving average, we have a bullish 50 period moving average, but we have a very flat 200 period moving average. So we'd have to say long term in this left hand side of the chart, this is going back about a year now, I think. What year is this? This is 2016. So in the spring to early summer of 2016, we had a neutral long-term trend, trading range, we might say, or neither bullish nor bearish for the long-term picture of the Dow Jones Industrials. But on the short term and on the intermediate term, we were in an uptrend. In fact, we were in a quite strong uptrend. You can tell by the slope of these two moving averages, very strong. And then we get into this period of very choppy market consolidation, market indecision, not very good stuff going on. This happened to be, I believe, around the Brexit vote, where things were initially, the night before very bullish, thinking that England would stay in the EU. The day after, very bearish. And then a few days later, investors decided, hey, it was not so bad after all, and they pushed the market up to new highs. So this period right here around the British election was very choppy and indecisive and very volatile, as reflected in the moving averages. Flat, flat, slightly sloping up here, which is interesting on the 200 period moving average, because now it's starting to reflect this activity back here. So longer term, things are starting to look a little better for the 200 period moving average. And the 200 period moving average is your granddaddy of the moving averages. It's kind of the one that is the patriarch of the family. The two younger ones, the daddy and the child, tend to obey the granddaddy moving average sooner rather than later. And so when your 200 starts to turn up, that's always a good sign. You want to see your 200 moving in a bullish direction if you're bullish on the market overall. Because it's the big term picture, it's the longer term picture, it's the one that's going to predominate going forward. So then we had this resumption of the bullish trend, and then we had all this confusion in the months and weeks preceding the American election, the presidential election, and of course, night before, very bearish. The day after, extremely bullish. I mean, look at that skyrocketing movement up. In the several weeks after the election, investors were very, very happy with the outcome, and everything started moving back up again, including your moving averages, right? All three. So slope of the moving average is something we use to determine the overall health of the market and the overall bearish or bullish posture of the market. The other thing we look at is the crossovers. Now, I personally don't put a lot of stake into crossovers, because by the time the crossovers take place, where one moving average crosses over or under another moving average, the bulk of the move has already taken place. In general, it's better if you can get in before the crossovers happen, because by the time the crossover actually happens, the best money has already been made. But with that said, it does help us pay attention to when we go through a period. I mean, this is quite a long period here of all three moving averages lined up in the best of all possible worlds, which is the 20 above the 50 and the 50 above the 200. That's very bullish. We've also got quite a bit of spread between these three. That's also very bullish. Prices above the 20 for the most part, and certainly above the 50 for the most part, also very bullish. But then we get over here toward our right edge of the chart, and we start to see this kind of consolidation happen, and we get this little crossover right here. This is a bearish crossover of the short term over the medium term, the intermediate term. That's not to say that we should now be bearish on the market by any means. It just is a warning signal that investors aren't quite as happy with the market now as they were just a few weeks ago. In this period of time frame, they're very happy with the market. They love it. Over here, they're a little bit more indecisive, a little bit more cautious, a little bit more protective of their capital. So these crossovers, we pay attention to them, we note them when they happen, but I don't think we should be making trading decisions strictly on them. Now, I've developed a moving average trading system, but we use much shorter time frames. We go way down in terms of our time frames, and those signals can be, in the short term, very profitable. But these longer term time frames, 20, 50, and 200, by the time you get the signal, the bulk of the move has already been made. You're also going to get, especially with the 20 period moving average, which is a short time frame, you're going to get a lot of these little whipsaw movements. Here's a bearish move, here's a bullish move, here's a bearish move, almost identical to the 50 right here, and another bullish move. So this sort of period right in here is called whipsaw action. And again, you really cannot base your trading on these sort of crossovers. all we do with these crossovers is simply note that there is this indecision in the market. We're still well above the 200, so everything is still bullish in the long term right in here, but in the short term things are pretty choppy, and this is not the best kind of market condition for your trading. Note over here that we get a couple of nice bullish crossovers of the granddaddy moving average, the 200. First, the 20-period moving average crosses over, then the 50-period moving average crosses over. The 50 crossing over the 200 from a bullish, in a bullish way, is called a golden cross. And when the 50, which happens back here, right here, I believe, when the 50 crosses over the 200-period average in a bearish way, that's called a death cross. Very dark name indeed. But again, you can see that by the time the death cross happens, price is already way down here, and it didn't go much further than that. The next real big move in the market was to the upside. So you can't just trade the death cross. By the time you sold short the death cross, there's not much profit for you, and you're risking all of this upside here. And then when you get the golden cross, price is way up here, and that was just about the highest price you got over a period of 2 months. So you'd have to sit through an underwater position for 2 months if you were trading that golden cross. So again, don't trade the crossovers, just simply take note of them and note the relative positions of the moving averages to each other. Okay, now the third thing and the final thing we'll look at with moving averages is the relationship of price relative to moving average. And here's a general rule of thumb which you can build a very profitable trading career around. And that is the moving average tends to act as a mean of price, and when price gets too far away from that mean, we tend to see price in the very near term revert to the mean. Think of the moving average acting as a kind of rubber band relative to price. There's no magic in this, and there's no, there aren't any physics involved in price moving away from the moving average. But just because moving averages are in fact averages of price, and because price tend to stay pretty close to average, otherwise it wouldn't be an average, right? When price gets too far away from its average, it tends to revert back to its average. It tends to revert back to the mean. I have a whole trading manual on this phenomenon. It's a system that I built called mean reversion, the mean reversion system. You can get it from our site if you want, the old site, drstocks.com, our primary flagship site. You can buy it there if you want, but I also have it written up in my book, Market Neutral Trading. And I don't mean to pitch any of my products there. I'm just saying that I believe in this phenomenon strongly enough to actually, publish it as a trading system, because it does work quite well. So here, for example, we have the price moving very far away from the 20-period moving average and the 50-period moving average, kind of a double whammy. We also have it pulling into the 200-period moving average, which is beginning to rise up. So three marks of bullishness in a row, and this tells me there's no way I'm going to short this right here. This is an extreme move in price. Of course, this is the move right around the election. This is the move right around Brexit. And it was an extreme move in price for sure. But if you had bought back here at 171.25 on the close of this trading day, because you're very far away from the moving average, then you could have sold it 3 days later at 179. 179. That's a move of almost 8 points on the Dow Jones Industrials in 3 days, which is a very big move indeed. They tend to not move very fast because, it's comprised of these massive, huge market cap companies like ExxonMobil and Apple and JP Morgan and Intel and so on, Microsoft. Okay, so reversion to mean. When price, let's look at a bunch of these here. When price gets far away from the mean, they tend to revert back into the mean. When price gets far away from the mean, They tend to, in this case, revert way above the mean. When price gets far away from the mean, here it did not revert back to the mean, but it began to cool off quite a bit for several days in a row. Let's look at some in the past. When price gets far away from the mean, look at this low way down here. That's here is the low at 154, and the mean above it is at 168. Now that's a 14-point move away from the average. That is huge for the Dow Jones. You don't see that very often. This is the kind of thing you want to buy. You don't want to sell short right here. You want to buy. You want to double down if you're already long, because, man, you know that's going to pop back into the mean, and it sure did. When price moves very far away from the mean, here's a good one. This is 150 at the low, and the mean was 174. That's 24 points below the mean. You know you got to buy that. You have to buy that because that's going to snap back into the mean very quickly, and it does 2 weeks later. You're back up here to 166. Now, of course, your mean is coming down into price because that's what the mean does. It averages itself out. So the mean is moving toward price. Price is moving back toward mean. And where the two kiss each other right there, that's where you want to exit. That's the reversion back to mean. Now, I have a number of rules that I use on this particular system because there are some ways you want to protect yourself against a market crash or a market rally that takes you out of your short position. There are some other other technical indicators you can use to determine the very best, highest quality reversion mean moves. Here's another one, good one. Too far away from the mean tends to revert back into it. Too far away from the mean tends to revert back into it. Too far away from the mean onto the upside tends to revert back into it. Okay, so those are the three things we look at with moving averages: the slope, the crossovers, and the relative distance of price away from the mean. If you find a chart that you like that looks very bullish and it passes through all the technical parameters of your trading system, as you'll learn, that we've got some filters that you're going to be using when you're searching for stocks to trade given our two trading systems. Then you also want to take a look at the moving averages. What do the slopes look like? What are the most recent crossovers looking like? And how far is price away from the mean? If I'm very far away from the mean, I may, and I'm to the upside of the mean, and I'm above the mean, then I'm not going to buy that just yet. I may wait a few days to see if it pulls back in. If a stock passes through all my filters and everything looks bullish on the moving average, and price is very far below the 20-period moving average, which is your most dynamic moving average, very far below the 20-period moving, I'm all over that. I might even double up on a trade like that because that has everything going for it in its favor. Okay, so moving averages are ways you can add a bit of nuance and sophistication to your trading, and it will certainly help you stay on the right side of the market. So our next indicator, technical indicator after moving averages, is trend lines. We've already looked a little bit at trend lines. We've talked a little bit about how they're drawn, but let's go ahead and look at those now in greater detail. So as we've seen, trend lines are what we draw over on top of the chart. It's not a technical indicator that a computer will generate like the moving average, but rather it's something that we draw in. So there's an element of subjectivity with trend lines that is just an inevitable part of our our analysis process. There's nothing we can do to get away from that, but there are ways that we can implement to make things as objective as possible. So let's go over to the chart. We'll take a look at how we draw in trend lines. Now, we've already seen a little bit of this already, so some of this is a bit of review. The first thing to determine in general, your first step in drawing in trend lines is to determine whether we are currently in the price period under consideration in an uptrend or a downtrend. That will determine the slope of the trend line that we draw in, of course. Now, if you have moving averages overlaid as we do here, you can just take a quick look at the moving averages, and they'll tell you whether you're in an uptrend, downtrend, or something in between. Obviously, this period of time for the Dow Jones Industrial Average is an uptrend. If we remove those trend lines, because it's a bit of cheating to have those on there for now, and no problem with having them on, but once you start having moving averages drawn on the chart, trend lines drawn on the chart, your support and resistance lines drawn on the chart, you're going to end up with a very messy chart. So let's try to keep things as clean as possible. Now, rule number one in trend line is, do we draw them sloping up or sloping down? If we're in an uptrend, we'll draw them sloping up. If we're in a downtrend, we'll draw them sloping down. Obviously here we are in an uptrend. Rule number two, if we're in an uptrend, then we start with the lower line, the line under the pivot lows of price, or what is also called the support line of the trend channel. When you have two trend lines in place, one at the bottom, one at the top, you've got a channel, price contained within that channel, and then the lower line, the line under the lows, is your support line. The line over the highs is your resistance line. So let's go ahead. This is following now our rule number two, which is to first draw in our support line, because obviously we have an uptrend. So we click on our drawing tool here, and we will start down here at the most recent pivot low, and I can draw in my trend line, which will only encompass one other pivot low. You only need two touches to form your initial trend line, either support line or resistance line in the case of a downtrend. You only need two touches to establish a trend line. That's it. That's we'll call that rule number three. If you have more, great. The more the merrier. But this is telling me that we're in a fairly wide-ranging trend line, a trend channel, I should say, uptrend, because in a narrower sort of trend channel where price is moving up and down quite regularly within the channel, you're going to have more than two touches. You're going to have maybe 4, 5, 6 touches of the trend line. So this is our primary trend line. We call that the primary line. It's also the support line. It's the one we draw in first over the highs of this uptrend in the time frame that we're looking at. Now let's then draw in our resistance line, and our rule number 4 now is that the resistance line has to be parallel to the support line. We want to draw it in a parallel fashion and incorporate as many pivot highs as possible. Now here it's quite nice because we can incorporate this area of high, which was clearly an area of resistance, because after it hit that period, it went flat. There are all sorts of fundamental reasons why a price will hit a specific point and then either pull back, sell off sharply, or go into what, this most bullish of all cases, which is the sideways consolidation period. And maybe at this point the market is getting a little bit ahead of itself. Maybe this is where most stocks in the Dow Jones Industrial Averages are fairly valued. Maybe there's some indecision going on in Congress, or some geopolitical risk that needs to be factored in, needs to be weighed in. There are all sorts of reasons why price would pause right here, but the fact that it has indicates to me that it's not going to go any further for a little while. And in fact, it doesn't. It stays under that line. So in our trend channel, we are not going to get another touch of the resistance line for a while. In fact, after you have a touch of the resistance line, your expectation is that the next touch within the trend channel would be to the opposite side, which would be to the support line. But this is such a strong uptrend that we don't get that. It goes right back up to establish our second pivot high, and only then do we get our second pivot low, indication of a very strong uptrend. So here we have our trend channel, and we've drawn in our two trend lines. And the only other thing to say about trend lines at this point is that something that you can do if you wish, it's optional, is to draw in a third line which runs from the, sorry if I can get it right here, kind of hard to get it up into that corner. We can get it about there, and then that's about it. Anyway, you want to draw it from as much as you can, from the lower left-hand corner to the upper right-hand corner, to give yourself a 45-degree angle. That's your marker for a 45-degree angle, because the 45-degree angle for a trend channel, is your most sustainable trend. That is your sustainable trend. That is the sweet spot for trends. It's the bread and butter for trends. When trends start to get stronger than 45 degrees in terms of their angle, then my first initial understanding of that trend is that it's an unsustainable trend. You can't sustain a trend going faster than 45 degrees for very long. Now, sometimes they do, but the rule, by and large, is that they tend to pull back very sharply if they get too far ahead of themselves, too far ahead of a 45-degree angle. And conversely, trends that are shallower than a 45-degree angle tend to be rather weak trends. Now, they are also sustainable, but they take much longer to make money from because you have to sit through much longer periods of sideways consolidation, choppy price action, back and forth, give and take, because it's not a strong uptrend. But your 45-degree angled trend is your sweet spot for trends. So it's just one more way of determining whether we like the chart or not. In this case, I like this chart. It is a strong uptrend with 2 price pivot lows, 2 price pivot highs, nice and symmetrical. And it's roughly speaking at about a 45-degree angle. It might be just slightly sharper, but really not much. So that's a sustainable uptrend. We've just had our pivot low established, our second one, giving us the support line. So our expectation is that the next touch of one of the 2 trend lines will be the resistance line, and that's going to be way up here, not even on the chart yet. So we're really looking for a very bullish move. That's our expectation of the Dow Jones Industrial Average going forward. Doesn't mean we'll get it. All sorts of things can happen. All the rules that we use in technical analysis don't give us hard and fast rules. They give us probabilities, and that's about all we have to go with. Okay, so that's a trend line on the downside. Now, if you were to move in on this chart a bit, and let's say we're just interested in this period of time because we want a bit of a nearer term look at the market, then let's give us back just a little bit. Then we would have to draw in our trend channels a little differently. We would do something like this. That would be our support line, and here we have 1, almost 2, 3, almost 4, 5 touches of the support line, and our resistance line by rule is over the top of the highest pivot high, and then we make sure that that is as parallel as we can get it. You just have to eyeball your chart. Now, there are tools. You can use the pitchfork tool if you want to make sure that they're exactly parallel, but close enough is fine by me. And what I'm looking at here is that if we put in our 45-degree angle, then we can see that we're actually shallower than a 45-degree angle. We're shallower than a 45-degree angle in the near term, which just tells me that this is a trend that is cooling off a little bit. It's taking some time off, and we've already seen that. We've already seen this sideways price consolidation going on here. We looked at this sideways price consolidation going on here, and we're just saying that, you know, this is a trend that is still very strong in the bigger picture, but in the near time frame, it's beginning to cool off a little bit, beginning to consolidate. Not a worry. We still expect a breakout to the upside. In fact, when a strong uptrend cools off for a little while, that's a good sign, because your next leg up is likely to be, again, a very strong move to the upside, even stronger than 45 degrees, because it's now playing catch up. Okay, so that's trend lines on the downside. Let's remove all drawing tools, and let's scroll back a little bit, and let's look at something on the downside here. There's not a whole lot. In fact, let's put in a stock that I'm pretty sure is in a downtrend. At least it has had some recent. Yeah, here we go. This is U.S. Steel, which is a large cap steel company, and it's in the last couple of years, it's had some problems, had some issues, losing money. And this period of time that we're looking at right here is a very well-established long-range downtrend. Now, in a downtrend, rule number one is determine whether it's a downtrend or uptrend. Obviously, it's a downtrend because we're here starting up here at the upper left-hand corner and we're ending up here down at the lower right-hand corner. And just eyeballing this, I can tell that's a 45-degree angle of a trend. So anywhere in there would be a good place to establish a short position because it's going to be sustainable. Rule number two is that we start with our resistance line in a downtrend. Let's see how many pivot highs we can cover here. There's 3, and I'm not too worried about this little breakout move here. It obviously was a false breakout, so I'm just worried about running this line through as much price congestion as I can, trying to get as many pivot points touching that line as possible. You can draw your trend lines however you wish. You don't have to draw them the way I do, but I don't feel constrained to get every little intraday move inside the trend channel. I'm simply trying to get the major moves around that cluster around those resistance lines as much as possible. So there's our resistance line, very clearly drawn, not a big deal, very easily done. And then of course we want our support line parallel to it that incorporates as much of that price action as possible, and we can actually get, let's start it right there, we can actually get quite a bit of touches there. There's a good cluster right there at the top. We have one here in the middle. We have another nice cluster here down at the bottom. These are areas that have precipitated strong relief rallies, what we call relief rally, because it's in a downtrend, what others call dead cat bounces and so on. And of course, when the relief rally starts to peter out, that's a very good place to go short. But that's your trend channel. If you were to come across this stock right about here, with that already established as your trend channel, and of course this looks like the continuation of a much larger downtrend, then I would say, yeah, I'm not going to buy this stock. I'm going to short it right here with that 45-degree angle trend channel, and boom, nice trade. Then we get the flat recovery period, what in business cycle is called the trough, with a period of nice expansion, a higher low, another higher low, and a new higher high. And then, oh, look, nice big move. I guess I was trading this stock back in that period, looking for a breakout to the upside, which never happened, and now we're back into a downtrend. So in the most recent price action of the market, we're again looking at downtrending action. We have a nice resistance channel about there, and we have a support channel there, but then we have this whole period on the outside. This is a real anomaly, and of course we have to include that in there. So what we have to do then is pull our support line back out to something like that, and that would be our current trend action, our current trend channel, quite a wide one here. And this is not the kind of chart you would really want to trade, because it's pretty hard to get a read on this sort of thing with that big gap filling in there and this very wide trend channel with very little in the way of touches down here at the bottom on the support area. It's not a very well constructed trend. If we pull back a little bit, maybe you might be able to say that, remember, your support line now always has to be parallel to the resistance line, and it's just hard to make something that's going to be parallel that includes that island of action right there. It really throws us off. So anyway, that's how you draw trend lines, and what you do with them is that you use them to determine price action going forward. Your expectation for price action going forward is always that price will be contained within that trend until the trend comes to an end. And then you start looking for the new trend, either to the upside or the downside. Okay, let's go back to our PowerPoint. And our next technical indicator is similar to the trend line because we will be drawing these in by hand. So there's a little bit of subjectivity here, but actually less so than the trend line. And that is the support and resistance line. And let's get back to our chart, and you'll see what I mean by this. Okay, let's remove all drawing tools, and let's get another stock on here, one that I have a long-term position in that we've recommended. We recommended a couple of years ago in our Ichthus letter, and it's going strong, is Tesla, the big car company, now the #1 largest car company in the world, even though it hasn't made much in the way of profit yet. But anyway, I could talk about Tesla all day long because I'm very interested in the company itself. I don't see it as a car company. It's more like a tech company. But in any case, it has a very interesting chart, and clearly in recent price action, we are in an uptrend. But with support and resistance lines, we're not worried about the trend. We've already done trend analysis with our moving averages and with our trend lines. That's enough. That's all we need to do. What we're worried about here with support and resistance lines is where are the horizontal levels of price support. And if the price is in an uptrend, we would expect price to be bought at the support line. And where is our horizontal level of resistance? So support and resistance lines are always drawn horizontally, which means that they're always going to be parallel. So we don't need to worry about making one parallel to the other. And support and resistance lines are very easily drawn. You would first kind of figure out what time frame am I most interested in. And a good rule of thumb to determine that is, how long do I hope to hold the trade? Am I hoping to hold it for a month? Well, then my time frame is going back in time is maybe 2 or 3 times that, 2 months to 3 months. Am I hoping to hold this for a week? Well, again, my time frame is 2 to 3 times that. So say 2 to 3 weeks, we want to go back. In most cases, when you're trading the daily chart, you're trading the types of trades that you'll be doing with the 2 systems that we'll teach you at the end of this course. You're going to be looking at holds of about, I would say about 4 to 6 weeks. So 4 to 6 weeks times, let's say times 3 is about 3 to 4 months. So this is May, April, March, February. Let's mark the beginning of February as the beginning of the time frame we're interested in, and let's put in our support and resistance lines. What's the highest high on the chart? The highest pivot high on the chart in the time frame we're interested in, it would be right about here. Now, we're not going to include the intraday movements. If you're using a line chart, this is very easily seen because that eliminates the intraday movement. Forget about these topping tails. We're not going to worry about that. We can put remember the closing price is your bread and butter price. And so that actually, if we're working only with closing prices, then we'd actually move it down a little bit right about there. 323, 320, 350. That's our area of resistance right now. Now, on the support side, we have to go all the way down here, and we're looking at support down here at about 246, 245. So those are the 2 key areas. And of course, present day price, which is represented by this red candle right here at the close of that trading candle, is closer to resistance than it is to support. Now, that doesn't mean that I expect price to now go all the way down to support. It doesn't mean that at all. These support and resistance lines do not act as magnets in the same way that moving averages do, in the same way that trend lines do, because a trend line supports the trend, and trend has to do with the price going forward, the momentum of price going forward. Support and resistance lines, they don't act as magnets. They don't really give us much information for trading. What they do tell us, however, is that if I'm buying Tesla here at 307, then I expect if and when price gets up here to 324, I'm going to run into some resistance. There is a lot of people up here who maybe they bought these shares right up here on these high peaks, And when they see price getting back into their area where they bought, they're going to say, you know what, I could get out right here and break even on my trade. I'm going to do that. So you have all of this overhead supply that comes into play, because when price got up to this level before, it sold off. It sold off quite sharply over the past 3 days. Now, there was some earnings. You can see the E down here marks the earnings that played into that. So there's some news involved in this event. But what this is telling me in general is that investors and analysts and traders all consider Tesla to be overpriced above 324. They also consider it to be underpriced down around 245, because that's where you get all this buying activity. People were buying, and in fact, if we scroll out a little bit more, we'll see that, you know, this has been support for quite some time, right? All the way going back to the late January, it's been an area of price support. So if I did see price coming all the way down to here to 245, not likely anytime soon, of course, then I would understand that to be a very good place to buy. If I'm short the stock, that would be a very good place for me to cover my short. So support and resistance lines are not things that you necessarily trade on unless, of course, price is right at support or right at resistance. If price is right at support and I'm bullish the stock, I would consider buying it right there, because that's an area that it has really propelled upward from in the past. If it's done it in the past, it should do it in the present or future going forward, unless there's been some major change in the company itself. If there's no major change in the company, then we should see the same thing repeating again. And the same is true if I see the price up here at resistance, I might consider shorting it there. Or conversely, if I'm bullish the stock, which I am in general on Tesla, I would wait for a breakout above that resistance, and not just this little intraday stuff, but a healthy close above that resistance line. That tells me that the stock is ready to rally to new highs. So support and resistance lines, again, we don't use them to make, we don't use them as part of our trading system necessarily. Our interest is only in them when price is very close to them, or if price is somewhere in the middle, then I'm going to be cautious when it gets up to resistance, and I'm going to be bullish when it gets down to support. Okay, so that's it on support and resistance. Let's go back to our PowerPoint, move on to the next technical indicator, which is the MACD indicator. And this is kind of the granddaddy of all the technical indicators. It's been around for a while, and it is based exclusively on price action alone, and it's based exclusively on moving averages of price action. So this is one of the most reliable momentum or trend indicators in the technical analyst's arsenal, and it's one that has a wide variety of uses. So I'm excited about introducing it to you here if you're not familiar with it. There are all sorts of ways that you can use the MACD indicator to your advantage for analysis purposes. So let's take a look at that here. The MACD indicator has three main parts. And by the way, we call it MACD because the name is an acronym. It stands for Moving Average Convergence Divergence. Moving averages that move close to each other or diverge far away from each other. And the MACD is composed of three parts. There's the oscillator line. This is your fast moving line, your most responsive line. And it's comprised of the difference between two simple moving averages. Now, by default, your MACD is calibrated to calculate the 12-period simple moving average of price, closing price, and the 26-period simple moving average. Now, those are two kind of strange numbers, right? We've seen 20 and 50. Here we have 12 and 26. Why 12 and 26? I have no idea. Whoever developed the MACD must have decided way back when that these two work the best. In fact, they do. I've tried different configurations. I've tried using Fibonacci numbers. I've tried using, 12 and 50, 20 and 50 rather. Nothing seems to work quite as well as 12 and 26. So there you go. So we're not looking at a moving average either the 12 or 26. We're looking at the difference between the two. Obviously, the 12 is shorter than the 26, so its price is a lot more fluctuating. 26 is a longer period moving average. It's a bit steadier, and so that means there will always be a difference between the two. If the 12 is above the 26, the difference is going to be a positive number. If 12 is below the 26, it will be a negative number. Positive numbers are bullish, negative numbers are bearish. Then there's a signal line, which is, it's going to look like a second moving average on top of the oscillator line, and it is in fact a moving average of the oscillator line. By default, it is a 9-period. It's not a simple moving average, it's an exponential moving average, an EMA, of the oscillator line. Now, why 9? No idea. But again, 9 seems to work really well. So there you go. The signal line, of course, is a lot less responsive to current price action than the oscillator line. It moves more slowly. It tends to be lagging quite a bit. So the oscillator line will cross above and below the signal line, and whenever it does, you get bullish and bearish signals on the stock itself. Very easily done, 100% objective signals. And then thirdly, there's a piece of the MACD which we won't be referring to very much. It's used in trading systems, and I have one that I use it in, but we won't be using it in our systems here necessarily, but it is one that is interesting nonetheless. It measures the difference between the oscillator line and the signal line. So it's kind of the difference of the difference, if you understand what I mean. It's the difference of the difference between the difference and the average of the difference. But anyway, and it's constructed as a plot of lines, bars, I should say, both above a zero line and below a zero line. So when the difference between signal and oscillator is negative, the histogram bars hang below the zero line like stalactites. I hope I got that right. And when the oscillator is above the signal line, that's a positive value, so you're going to get a positive histogram. The bars rise above the zero line like stalagmites. And the histogram has these nice sort of rolling peaks and valleys on them, and you can use the histogram as a standalone indicator, in fact, to look at things like bullish and bearish divergence relative to price lows and highs, and you can look at the strength of trends, and you can use it in the construction of Elliott wave analysis. It's something I don't recommend necessarily, and I don't use myself, but it is used in a variety of ways. We just won't be using it here so much. So let's take a look at the MACD indicator. Here we have a chart of the SPX, the S&P 500. You can see the S&P 500 with a flat period, a down period, an up period, a down period, an up period, a down period, an up period. And that's pretty much measured in the MACD. The black line is our oscillator. The red line is our signal, and the blue bars above and below this zero line right here, which is marked on the chart, is your histogram. And you can see that for the most part, the MACD will decline as price declines. It will rise as price rises. It will fall and rise and fall and rise with the rising and falling of the price of the underlying itself. Nothing extraordinary there, but what it does give us is objective crossovers that we can use as signals in particular cases to determine our entries and exits into the stock or into the index. It's also of interest to note whenever MACD and the price itself diverge from each other. So for example, when price is just slightly trending up, as it did over here in July, I don't know what year this is, 2014, so it's going back a bit. When it's trending up here in June, July, and into August, and the MACD is falling, as it does just slightly here, that's not a good sign. That's a bearish sign. When price of the underlying index hits a higher high on the price chart, but MACD fails to hit a higher high, that's not a good thing. That's a bearish thing. So there are different ways you can use MACD, but anyway, that's how it's constructed. And we will be using the MACD in both of the technical strategies that we'll be looking at here in just a little bit. So here are 10 ways you can read the MACD. 10 ways you can use it to determine the bullishness or bearishness of the chart in question. And that just some general rules, and they all follow some common sense, I guess. So a rising oscillator line, that's the difference between the 26 and the 12 period moving average. A rising oscillator line indicates a price uptrend. Duh, right? File that under duh. And a rising oscillator line above the signal line indicates a strong uptrend. So we can read these just as we do with moving averages. We can look at the slope, we can look at the crossovers, and thirdly, a rising oscillator line above the zero line and the signal line is the strongest uptrend. So we can use the MACD indicator off to the far right edge to determine the current trend of the stock or ETF or index and how strong a trend is. You have 3 grades of trend strength. We would probably call this, I don't know, moderate, strong, and very strong in terms of its trend strength. Fourthly, a crossover from below of the oscillator and the zero line indicates a good time to buy. So in other words, the oscillator itself is crossing over the zero line. Remember, the zero line is that flat line that determines whether your histogram is going to be above or below it. So if the oscillator crosses above the zero line from below, that's a good time to buy. That's a buy signal. Just a sheer crossover of the oscillator and the zero line. But an even better time to buy is when the crossover of the oscillator happens when it crosses over the signal line. So sometimes the oscillator will cross over the zero line before it crosses over the signal line, and you have to wait a little bit to get the best possible time to buy. Sometimes the oscillator crosses over the signal line before it crosses the zero line, and that's also a good time to buy. So this signal is better, stronger than this one, because this tends to be a little more responsive to current price action. This is more of a kind of a general bullishness, general bearishness. This is more of a precise kind of entry into the stock. And then our other 5 ways of reading the MACD are just the flip side of that, but let's look at these first 5. So let's look at the oscillator here. Obviously, a downsloping oscillator line is bearish. A downsloping line below the signal line is more bearish still. And a downsloping line below the signal line, below the zero line, is the most bearish of all. And the same is true on the upside. I should have just done all that on the bullish side, but nevertheless, you get the idea. When the black signal line starts to turn up, that is a moderate uptrend beginning. When it crosses over the signal line, like right here, that's a strong uptrend beginning. And when it crosses over the signal line and the zero line right here, that's the strongest trend beginning. Okay? We see the same thing over here. Uptrend, stronger uptrend, strongest uptrend. Okay? And all of that is true on the downside as well. Now, when is a good time to buy? A good time to buy is here and here. But this time right here is better than this time right here. This time right here, it's a little bit further on, even though this is the strongest of all possible trends, but it just simply means that, the trend is only your friend until it comes to an end, and it's much more likely to come to an end after this point than it is after this point, because this is early on. Good time to buy, better time to buy. Okay? Now, let's look at the other 5 ways of reading the MACD, and they're all bearish. A falling oscillator line indicates a price downtrend. They're just the opposite of what we looked at. A following oscillator line below the signal line indicates a strong downtrend. The following oscillator line below the zero line and signal line is the strongest downtrend. A crossover from above the oscillator and zero line indicates a good time to sell. A crossover from above the oscillator and the signal line indicates a better time to sell. So we can look at these kinds of signals here. A good time to sell a downtrend is when your oscillator, right here, sorry, your black line, your oscillator crosses the zero line, but a better time to sell is back up here when you get this initial crossover. Good time to sell the market is when you get a crossover of the zero line, but a much better time to sell is when you get a crossover of the signal line. And as I said before, all the same is true about the strength of trends. Initial downtrend, like right here, of course that coincides with your crossover. Let's maybe this little hook over here indicates that we're now starting into a downtrend. Once it crosses over the signal line, it's a stronger downtrend, and once it crosses the zero line, we're in the strongest of all downtrends. And if we look at simply positive and negative histogram numbers, and these are identical to the position of the oscillator to the signal line. So if the oscillator is above the signal line, the histogram is above the zero line. If the oscillator is below the signal line, the histogram is below the zero line. And just looking at that particular signal, that frame of reference, we can see that the MACD highlights pretty consistently bearish periods in the market and bullish periods in the market. Bearish, bullish, bearish, bullish. It doesn't catch every little jot and tittle of the move, but it does give us regions of bearishness and bullishness, which makes it important to take a look at the MACD indicator before you start looking at buying a set of stocks. Is the overall market, is the S&P 500 in a bullish posture or bearish posture? If it's in a bearish posture, then I might sit out for a little while, go do some fishing instead. But if it's in a bullish posture, then hey, all the green lights are on. Let's start looking at buying some stocks. And the MACD indicator will help you do that. One last indicator we're going to look at before we look at our two systems is the stochastics. Stochastics is an indicator that is also, like MACD, based exclusively on price action, but it includes a different way of looking at price. Stochastics is only interested in the extreme points of price on a closing basis from high to low over a given period of time, over what's called a look-back period of X number of days. So let's say the stochastics, and we'll set the stochastics at 14 trading days, which is a strange number again, but it's the one that's used as the default for stochastics. Why 14? I don't know, because it's not quite 3 weeks. 3 weeks itself is kind of weird, but nevertheless, 14 is your standard look-back period. A lot of quick turn traders will use the stochastic setting at 5, which is looking back over the last week of trading, which makes some sense too. But we'll be learning the 14 period stochastics as our standard setting. So the stochastic is saying, over the last 14 trading days, given the highest closing high and the lowest closing low, where is current price? Is it somewhere in the middle? Is it nearer to the highest closing high of that range? Or is it nearer to the lowest closing low of the range? And based on that, we'll get a reading of the stochastics. And then there's a second line that's used in stochastics, which is an average of the readings. So let's take a look here. Stochastics, there are 3 parts again. We have the oscillator line, which is just what I said. It shows us the percentage of the current price, either the percentage of distance away from the highest closing high or the lowest closing low. It'll always read out as a positive number, 50, the reading of 50 on stochastics means that it's right smack dab in the middle of that trading range. A reading of 80 suggests that we're up close to the highest high, which is to say we're in a bullish period, we're up strong, we're close to breaking out of that trading range. And a reading of 20 is more of a bearish posture, and we're down toward the lowest end of that range. Now, stochastics, that's the oscillator line. And then the smooth line is a moving average of that, and the default value for the moving average is always 3. So we're looking at the moving average of the last 3 readings of the oscillator line. That's our smooth line. So then you get crossovers between the oscillator and the smooth line. When price is tending to more quickly rise toward the highs of the trading range, you'll get a bullish crossover, and vice versa on the downside. The oscillator line is sometimes called percentage K. In fact, it's always called percentage K. I don't know why I'm giving you these oscillator and smooth lines, but that's what they're called in terms of building technical indicators. The oscillator is your standard line, and for some reason it's called percentage K. I don't know why. The smooth line is called percentage D. I don't know why. But anyway, those are the technical names, or the more commonly used names for the 2 lines of the stochastics. And then the third piece of the stochastics are these 2 horizontal signal lines, which are set at the values of 25 and 75 by default. Some of your charting packages will set them at 20 and 80 by default. TradingView does that. I don't know what else does. I think StockCharts.com puts them at 25 and 75. Now, let's look at the stochastics indicator, and we'll tell you how to read the stochastics. Here is stochastics down below, just as we had MACD down below. Here's a narrower range view of the SPDR SPY S&P 500 ETF. And we can see that we're set, our percentage K, that's our oscillator line, is set at 14. That's the default value. Percentage D is always 3. It's a 3-period moving average of percentage K. And black line is your percentage K. Red line is your signal line, your percentage D. And you can see you have some crossovers here, up here, down here, up here, down here, up here, down here. It's going to cross over quite a lot because every time you move forward a day, one of the values of that trading range drops off and you get a whole different set. And when you get a big move, a gap type move or a sharp sell-off, like some of these like a big spike right here or a big gap up like that, you're going to get a whole new trading range, and so you will get a lot of movement in your stochastics. For our purposes, because we are only going long in our trading systems, we're only concerned with stochastics that drop down below the signal line. I have set the signals here at 20 and 80. When stochastics drops down below 20, and if you want, you could set it at 25, but we'll use 20 here in this example at least. I forget where we set it in the trading systems that you're going to use, but you'll see in just a moment. When it drops down below 20, we technical analysts consider that to be an oversold condition. It's telling me that price is now trading down near the support of the recent trading range in a fairly extreme fashion. It has not been down this low in 14 trading days. This is the lowest low for 14 trading days. Now, can it go lower? Of course it can. Does that mean automatically we should buy that stock? Of course it doesn't. But what it does mean is that we are at support within the last 14 trading days, and that all other things being equal, when we start to see price moving up, we should see it move strongly up. And of course we do see that right here, but this is a very unusual case. This is the election, right, of 2016, where it moved very sharply up after a strong sell-off. When we see stochastics pull down, this is below 25, not quite below 20, but it represents this pullback right here, and that was a pretty nifty place to go long the S&P 500 because it just went up from there. Here we see another area of pullback. It throws our stochastics below 20. That's oversold. that turned out to be quite a nice place for us to buy S&P 500. It's now up about 239, almost 240, so it went up even a little further than that. So here's the general rule with stochastics. We can use MACD, we can use moving averages, we can use trend lines to determine whether we're in an uptrend or a downtrend. If we're in an uptrend, then when we see these oversold conditions, that's usually a good place to buy it. You don't want to buy it just on that factor alone. We'll see we have a signal that we're going to use to get into the trade. But when we see this kind of thing in an uptrend, we should start salivating, those of us who are bulls, because that's a good place to buy. That's a good place to buy in an uptrend. That's a good place to buy in an uptrend. This is getting close to a good place to buy in an uptrend. Okay? So that's stochastics. Now, stochastics works on the other side as well, but you can see that if it goes above 80, we would consider that to be oversold. You probably wouldn't want to initiate a new long position there unless you were really bullish, but you certainly don't want to sell short because we're in an uptrend. Never short an uptrend unless you're playing my mean reversion trading system, in which case be very careful when you short an uptrend. So selling short an overbought stochastics in an uptrend, not a good idea. But buying an oversold stochastics in an uptrend, good idea. Okay, I think that's it. Oh yeah, well, here we have those trading signals outlined, all three of them. And those all were nice places to buy the market, as you can see, each one making a nice upward move. Now, let's look at our two trading systems based on the chart reading skills that you now have as a result of our discussion. And one thing I should preface this with is that both the trading systems that we'll be looking at here can be very easily plotted into the screening tool of StockCharts.com. StockCharts.com is a very robust technical analysis screening tool, and you can code these systems in without having to know a single bit of code, because everything it's either drop and drag, or it's just very, very easily done because everything is obvious. And if you have any trouble with StockCharts.com, just simply email them with your query and they'll send back what you need to do. They're very good about that sort of thing. But you're going to need a paying subscription to StockCharts.com to access that tool. Finviz.com will get you about halfway there on the system, and that's pretty good. It's going to get you a very far way toward fulfilling every requirement of the system. But what you'll have to do at that point is you'll have to then make a watch list of charts and one by one scroll through the charts to find the handful of charts that satisfy all the requirements of the system. That takes some time. I would say on any given weekend, if you're doing this on a weekend for the next week of trading, you might spend upwards of 2 hours, doing your research. But it's easily done, and if you want to save some money and overhead costs, that's the way to go. Okay, so let's look at these two trading systems here one by one. First off, we're going to use the MACD only. This is a MACD exclusive system, and it's called the Bullish Crossover Strategy. And a couple of characteristics of this system is that you will get fewer signals than the other one that we'll look at, and each trade will be held for a longer time period. If that suits you, then this is a very good trading strategy to use. So let's look at the strategy itself. The bullish crossover strategy will start with either NASDAQ or New York Stock Exchange stocks. In both FinViz and StockCharts.com, you can, and Metastock too for that matter, you can code this completely into Metastock if you want. It takes a little more work because you do need to know a little bit of coding language, pretty basic stuff, but they have a complete tutorial that will help you do that. You want to start with stocks that are well traded, that are on the big boards, that are part of regular exchanges. You don't want to trade pink sheets, penny stocks, over-the-counter stocks using this kind of system because it's just not built for that sort of thing. So NASDAQ stocks or New York Stock Exchange stocks You start with those. I would recommend a current price over $5 per share. I have no problem trading lower price stocks. I do it all the time. Our cheap stocks letter, our brand new penny stocks letter, both trade low price stocks. But usually low price stocks are low price for a reason. And you can't just trade them on technicals alone. You have to dig down into the fundamentals of the company to determine if there's real value there. And unless you're willing to do all that, I would recommend starting with at least $5, even $10 per share. Investors Business Daily will not look at any stock under $15 a share. So that's their thing. They don't want to worry about the low price stocks, and there are special risks involved with those. So start with at least 5, if not $10 per share. Average daily volume over 500,000 shares per day. So these are liquid stocks. You're not going to get stuck in a thinly traded stock. And a beta value over 2.0. Now you can't input beta, at least you weren't able to input beta into stockcharts.com. They might have changed that by now. It's been a while since I've constructed screens there. But there are some ways of incorporating volatility into your screens. You simply plot in to the screen itself the highest 52-week high, the lowest 52-week low, the difference between those two. Divide that by the lowest 52-week low, and you want at least a factor of 3 there. So if let's say a $40 stock traded between 50 and 10 over a period of time, that would be $40 of difference divided by 10. 40 divided by 10 is 4, so that's more than 3, and that qualifies. So you're going to get some stocks that really move up and down a lot, and that's what you want in this particular trading system. Beta does the same thing. It tells us how volatile a stock is, how far it moves up and down relative to the S&P 500. But the little system I just gave you, highest high, lowest low, divided by lowest low, at least 3 multiple will give you the same kind of stocks. So you're good to go with stockcharts.com. Then current price over the 200 period simple moving average. So we're in a long-term uptrend because the current price is above the average annual price. And the MACD oscillator line is less than 0. It's below 0, which tells us that yes, we're in a long-term uptrend, but in recent trading, it's been trading down. There's pullback, right? Pullback. And that's usually a good time to buy an uptrend, is when it's pulling back. And then number 7, we have a number of indicators in a row, filters in a row, that all need to be satisfied. And what we're doing here is we simply want to make sure that we've been in a pullback or downtrend for at least 5 days in a row. And we know that because the oscillator line, the fast-moving line, is below the signal line. And it's been below the signal line in each of the last 5 days. Okay, hope that's clear. You can go back even further. I mean, the longer it's been under the signal line, the better. But we want it to be at least true for the last 5 days. And then, this is our entry point. Today, MACD crossed over the signal line. Boom, that's our time to enter. We can enter that trade on the close of trading that day. If you're running the scan in real time during the trading day, you can you can enter the trade at the next morning open. You don't want to wait too much longer than that. But that's your signal to enter. And so that's your first trading system. Let's look at some examples. All right, so we have MACD down below. We have the price chart of Apple up above. And Apple is in an uptrend, and all this area over here is area we're interested in because it's all above the 200 period moving average. For the most part, the 200 period moving average is rising. We don't have to have it rising. We just need to have price above the 200 period moving average. We need the oscillator line to be below the 0 line, which it is here. And we need the oscillator line to be below the signal line over the past 5 days at least, which it clearly is here. I mean, it's been under the signal line for the better part of a month. And then the last thing we're looking for is a crossover. We get a crossover right there. That's our signal to enter. It's one of these candles down here. I don't know which one exactly, but it's around $70 a share. Price went up pretty quickly from there. Here's another nice little signal. We get a dip below the zero line, which you need to see, at least 5 days below the signal line, which you need to see, and then we get our crossover. And again, we have an entry. I think the entry is going to be up here. It unfortunately took a gap down on earnings, so you probably would have been stopped out of that little trade. But then a few days later, you're back in and another good signal. And then a few weeks after that, you get another signal to enter if you missed the previous one, and you're up from there. And you're really holding on to these trades for several weeks at a time, because this is the kind of trade that signals really long-term changes in trend. MACD indicator is a more or less of a long-term indicator. It doesn't determine quick-term action. If you really want to get in and out of trades within a week, this is not your system. You want to trade the second system that we'll describe. But in this first system, you're looking at multi-week, even multi-month trades. And as you can see from the chart, of our 4 signals here, hang on a sec. Of our 4 signals here, there are 3 of them that went on to make some good money, and 1 was stopped out on the earnings loss. Now, you might not even want to hold over earnings, although it's never a bad idea in a stock like Apple, because usually things go up from there after earnings. Here's an earnings hold that would have been profitable. And of course, if you'd gotten in down here just before earnings, you would have had a really nice run indeed. So that's the MACD crossover. I note this period of time in red here because we're not interested in this time. If we get some signals, which we do down here, and it looks like those weren't bad signals at all, we nevertheless would not take them because they are below the 200 period moving average. Our risks are higher down there. The likelihood of the downtrend continuing is higher down there. So we're not going to trade this system in this period of time. Once it crosses over the 200 period moving average, then everything comes into play. Then our stock is a viable one. Now let's move on to look at Tesla, one of my favorite trading charts, and I have a long-term hold in Tesla as well. And this whole time period, except for the far right edge, we're above the 200 period moving average. We have a beautiful signal down here. Now, I really like to see these signals happen well below the zero line. If they happen just below the zero line, that's a valid signal. Certainly would take it if I were interested in this that particular chart for Tesla. But when they're far away from the moving average, when they're far away from the zero line, I'm really interested in that, because that is a deep pullback, especially after this long downtrend for both the signal and the oscillator. And when I see that crossover, I might even double up on something like that, because that's a deep, deep pullback all the way back to near the 200 period moving average, which itself is rising. Now look at this trade. You would have gotten in here around $120 per share. And 1, 2, 3 months later, you're up between 240 and 260. That's a very, very low. It's a double. It's a 100% move in 3 to 4 months. Not bad at all. Let's look at these signals a little more carefully. Here we have 5 signals altogether, 2 of which you probably would have been stopped out at for small loss. But the other signals, and this one, I don't know if that's a green arrow or not, you probably would have moved your stop loss up to maybe break even. By the way, as far as exiting the trade goes, first of all, you do want to place a stop loss on these trades, and your best position for your stop loss is below the 200 period moving average. If you can hold it under there, fine, especially starting out. When the stock really starts to take off, you probably want to pull it inside the 200 and start trailing it below the pivot lows. And maybe you're stopped out right about in here. But again, when you first start out, keep it below the 200 period moving average. And then as it starts to mature, pull your stop loss up. You can also exit if you want to try to maximize your profits in the shortest period of time frame when the stochastics rolls over. So obviously this would have cut you out of most of the profit of that trade, and that's not the best kind of thing. You don't really want to see that. You would not have gotten a good entry here either, because you don't get those 5 days of pullback that you need to see. So exiting just simply on the crossover of the MACD is in a lot of cases not a good idea. But when MACD gets way up high like this and then crosses over, that's certainly a time to at least take some profit off the table. That's an extreme move that's unsustainable. It's a greater than 45-degree angle, right? We've learned that that's unsustainable. And especially in a trading stock like Tesla, which is very volatile, you're likely to get some pullback. Okay, but by all means, use a stop loss, set it below the 200-period moving average, pull it into the trade under the pivot lows as the trade matures. Now, our second strategy is similar to the first, but we're adding on stochastics. I call it the bullish pinch strategy, and you're going to get more frequent signals with this strategy and shorter holding time for each trade. Here are the parameters for the bullish pinch strategy. Start with NASDAQ or New York Stock Exchange stocks, current price over $5 a share, average daily volume over 500,000 shares per day, beta over 2, all the same as previous. The fifth one is we're going to set our MACD indicator to a weekly reading of the MACD, and I'll show you how to do that in just a minute. There are 5 candles in a 5 daily candles for every 1 weekly candle on the weekly chart. So all we do is we simply multiply our default values by 5. So instead of 12, we have 60. Instead of 26, it's 130. Instead of 9 EMA, it's 45 for our signal line. Oh, sorry, that's the histogram. And no, I'm sorry, that's the signal line. Getting a little confused. And then we're going to set our stochastics to the default value, 14 for the percentage K, 3 for percentage D. And then a lot of your stochastics reads in your charting packages will have another 3 here, when I'm not sure why it's there, but it is. Just ignore that. And then we're going to set our stochastics lines to 80 and 20. In some of your charting packages, that's set by default, but otherwise you'd have to set that by hand. And then we're going to insist that our stochastics fall below the 20 line. That means oversold. And at the same time, our MACD signal line has to be above the 0 line. So if you can picture this in your head, if stochastics indicator is above the MACD indicator on your chart, stochastics has dipped down low, MACD has risen up high, that creates the pinch that we're talking about. When you see a pinch in the stochastics and MACD, that's usually a good time to buy. Now, we're not going to buy right away because stochastics can get oversold and stay oversold for a while. What we want to do is buy only on the first green candle or green bar if you're using a bar chart. That may take a couple of days because you might get a series of red candles in a row as stochastics becomes weaker and weaker. But as long as your MACD signal line is above the 0, then you're good to go as when you get a green candle. As soon as you get a green candle, you can enter that trade. So that's the system. What you're looking for on the chart itself are these pinches right in here. Low stochastics below 20. Whoops, didn't mean to do that, sorry. A low stochastics below 20 and a high reading on MACD well above the 0 line. See, the 0 line is way down here, right? MACD is way up here. Very bullish read on the MACD, very bearish read on the stochastics. That's called the pinch. And that's our signal to go long as soon as we get a green candle. And it doesn't matter if the stock loses money on that day, as long as the candle is green, you are good to go. Here's your pinch. Here's a pinch. Pinch, pinch, pinch. Pinch, 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 pinch. Okay, so we have in a period of I don't know, about a year, I guess. 4, 7, 8, 9, 10. We have 10 signals in one stock. And if you're trading, say, 20 stocks you've identified and you're analyzing these each day, you're likely to get a new trade on most days with this particular system. Here are those trades again. You can see most of them over the short period of time are profitable. These two in a row probably losses because they went down and just kept going down, not going up very much at all. And then they were preceded. They preceded, however, a very nice run indeed. A couple of nice low runs. Now you're wanting to not hold these for very long. And a good rule of thumb is that once stochastics gets back above the 80 line, you want to start looking for the exit. You don't have to exit right away because it can stay in overbought territory as it did. You know, here price keeps rising, right? You don't want to just sell it here. You want to sell it somewhere up here and get that extra dollar. And so you're going to have to kind of wait for a little bit. But when it gets above the 80 line, you're going to start looking for the exit, and you certainly want to exit when it crosses back down below. When it crosses back down below. When it crosses back down below. Those are good places to exit a trade. You're also going to want to put a stop on these charts when you're trading, and you want to put that somewhere underneath the lowest intraday low of the previous trading range. So once you're in the chart, just look back over the last few days of trading and see where the pivot lows are and place your stop a good 30-40 cents depending on how big the stock is in terms of its price. Put it below that area. Give your stock some room to run. And then as it's running, of course, you'll want to raise your stop loss off to protect your profit. Okay, so that's the stochastics MACD system. And again, we're not interested in this area off to the right side of the chart because even though we get some stochastic signals over there, our MACD has now fallen. Our oscillator line has fallen. Our signal line, rather, has fallen below zero. Not interested. Don't even look at that. Move on to another stock. Now, the one thing about this particular system is that we have to set MACD at the weekly time values. By default, it's set at the daily values, but we'll look at that in just a minute. Here, I'm sorry, you know what I did? Here, this is a brand new stock. This is Tesla. I thought we were still looking at NVIDIA. And on Tesla, we have 4, 8, 9 signals. And of those 9 pinch signals, it looks like 6 of them were likely some good profits. How much profit is, depending on how well you traded the exit. Always a bit of a trick trading the exit. But to be fair, we would have gotten stopped out at least on 3 of these. And maybe this one off to the right edge too if you weren't quick on the trigger of taking profits. Okay, and then last thing I want to mention before I look at a chart is that if you go over to our original site, drstocks.com, as a purchaser of this webinar today, you're entitled to half off your first monthly or quarterly payment on any of our stock pick letters. Just type half off, all one word, into the discount code box to take 50% off your first monthly or quarterly payment if you want to try some of our stock pick letters. But before I leave you, let me go into the chart itself, and here we have Tesla on the chart. Let's get rid of these lines. And let's overlay, or it's not overlay, but let's put on our MACD. And then we'll put on our stochastics. And sometimes you'll see in stock charts, you'll see slow stochastics and fast stochastics. You want the slow stochastics, and I don't know the difference between them. I think with that third 3 is probably something related to that. But anyway, stochastics. And that's what your pinch chart will look like, but we still need to get into MACD and configure it on a weekly basis. So here's our format. We're going to simply multiply these numbers by 5. So we put in 60, 130, and 45. And then that gives us a weekly look at the MACD indicator. And the swings here are just a lot bigger and smoother and less frequent in terms of crossovers, whereas the stochastics, you can see, very volatile, right? Up and down, a lot of signals. So you're going to get a lot of signals with this system, but you remember, you're not interested if MACD signal line is below 0. You are interested once it crosses above 0. Once it crosses above 0, then these stochastic reads come into play. And here's a green candle, right? That's your first green candle after the stochastics crashed below. I think that's your first one. And that's a great entry. Look, you bought it at around 250 and it traded all the way up here to 320. That is a big, big move. And of course you had another move right here. Nice little green candle just before the big spike. You almost triggered another one here, but not quite. It didn't quite get down to the 20 line. By the way, if you need to adjust the 20 and the 80 lines on TradingView, you open up Format, you go to Style, and here you have the 80 and 20. And you know what? We have the default value there. We need to change 5 to 14. That's a little different. Okay, so we nevertheless have a signal here, which is in essence the same signal as over here, but that would be your entry point. You only have one signal on this chart, and it's a very nice one. Very nice signal indeed. Okay. All right, well, folks, that's it for this webinar. This is level 1. Level 2 will take you further into technical analysis, and you'll learn another set of trading systems based on further skills that you'll have acquired by then. But otherwise, you are free to begin trading tomorrow morning if the market's open tomorrow with what you've learned in this trading chart, in this trading webinar today. God bless everybody. We'll see you soon. Bye now.